This is an environment of winners and losers.
The sum total in our mind is that people are cautious with regard to technology.
There is anticipation of disruption.
AI is creating a major disruption.
The real asset bubble is still in front of us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday after a two-day tech rout, Alphabet topping estimates and announcing a monster year of capex following a $1 trillion wipeout in software stocks over the past week. Embattled private market firms are lining up to report quarterly earnings. Ari's coming up this hour.
Yeah, and it just actually dropped. And what you're seeing, and we'll dig into the numbers, of course, is that the earnings per share came in lighter than expected at $1.45 versus the estimated $1.68. Look, we could break down all the numbers. What people are going to be looking for is A, exposure to software, B, ability and willingness to continue to finance the capital expenditure boom that we're seeing from the likes of Google and Meta and everybody else. Ultimately, we are entering a new phase of the tech cycle, which hinges on the leverage and the willingness to provide that from the credit market.
Well, let's talk about the capex from Alphabet. Check out these numbers, up to $185 billion. So take 26 and compare it to the last 3 years, it's more than that. It's absolutely ridiculous. And compare it to something like this. Let's go through the numbers in the UK. The borrowing of the UK and the debt market over the last 12 months, basically the capex projected from Alphabet over the next 12.
Yeah, what you said this morning before the show is that ultimately some of these tech companies are entire countries unto themselves. We've seen that with a market cap, for example, of NVIDIA itself, which is essentially the entire economy of a couple big European countries. So you start looking at this and you start understanding how this can dwarf all other narratives. There is a real question, though, with Google. Yes, their free cash flow does finance a lot of this, but not enough of it anymore, because suddenly the business model is changing, and that's what some of these numbers really do highlight.
These numbers contribute to a decent slice of US GDP. A range of estimates out there, but JP Morgan Asset Management saying that roughly 40% of the US GDP growth through the first 3 quarters of last year came from tech capex, and those numbers are rising, not falling.
And that's why actually there's a lot of consternation around all of this spending, because the spending is going to the GDP, the US economy, but are the jobs still coming with it? And there is that disconnect. You know, the president was asked about this in an NBC News interview. Apparently he doesn't really use ChatGPT or Claude, but he said it's not going to take jobs. And he talked about the internet and past revolutions we've had in this country and how actually it's been a productivity growth.
It's an uncomfortable but relevant question. Even if we had the jobs number tomorrow morning, got to wait a few days, but let's say we got it. Kit Chicks of SocGen, catching up with Vonnie Quinn in the last hour. If we were to have a jobs report on Friday, I wouldn't know what to do with it. That's the problem right now for market participants.
We got ADP numbers yesterday. No one knew what to do with them. We've gotten a lot of data, and nobody understands exactly whether it is good or bad or what we're looking at, because ultimately you're seeing wage growth in certain areas, not so much others. You're seeing healthcare gains, you're seeing education gains, but you're not seeing places that typically fuel the economy. What are we looking at? This is an economy in flux, and people are just saying, you know what? We're going to ignore it and do what? Buy gold, sell gold, buy silver, sell silver. It feels like there's a real churn amid the uncertainty.
I can't keep up with silver. Last time I looked, we were selling silver. Yes. That might change in the next 5 minutes or so. New schedule for the data. OK, so for payrolls, no longer tomorrow. That's going to drop on February 11th. For CPI, that report's going to come on February 13th. We'll keep going through the schedule later this hour, but that's the latest for jobs and for CPI. If you're just joining us, welcome to the program. Futures basically unchanged, but as you all know, beneath the surface, some vicious moves we need to get through this morning. Coming up, we'll catch up with Seema Shah of Principal Asset Management as AI fears rattle markets. Ed Mills of Raymond James as President Trump intensifies threats on Iran, and Mark Mahaney as Alphabet plans to double capex this year. We begin this hour with stocks struggling to stabilize following 2 days of tech losses. Seema Shah of Principal Asset Management writing, AI's productivity and economic benefits remain more prospective than proven, underscoring the importance of diversification. Seema joins us now for more. Seema, welcome to the program and good morning to you. The sell-off in tech, is it a problem for tech investors or a problem for the market?
Good morning, John. Well, I mean, I think it's a problem for a bit of both. I think the good news is that there's other opportunities out there. But before I go there, I mean, I think we have seen this build up. The shift has been building up for the last couple of months. I mean, in Q3, Q4 of last year, the narrative around tech and AI was really about questioning of valuations, about bubble, the capex spend. And now you're seeing it shift even further, so that there's not just questions about valuations, but it's actually the models. Can they actually deliver? Which part of the market could they cannibalize themselves, etc.? So increasingly for investors who once upon a time could see this as a one-way trade, this is really about dispersion and understanding not just balance sheets, but what is the model, how exposed are they, etc. So I think for that reason, it makes sense that investors start to think about where else can we go. And the good news is that it's a strong macro backdrop, not just in the US, but globally. And that means that there are other opportunities. And certainly we are seeing clients increasingly ask the question of where else can we go?
Well, let's start with the US and then we can turn to the international story. Equal weight yesterday, all-time highs. Bank stocks, regional players, just short of a record at the close. Bank of America, 5-day winning streak for Bank of America. What is happening elsewhere in the market away from the technology story?
Right, so we've seen this broadening out of earnings growth. We've seen a number of sectors really performing well. And I think that's backed up generally by this strong economic backdrop that we're all talking about all the time. That resilience is playing through in cyclicals, but it's interestingly, we're also seeing in areas like consumer staples. So clearly AI beneficiaries, cyclicals, and areas of the market that maybe hadn't performed well in the run-up over the last couple of years. So I think there's a number of narratives going on. And so investors are increasingly wondering, which ones do we want to pick?
Seema, I wonder how much this is technical as well as fundamental. Yes, there have been some reasons for there to be this incredible violent rotation that we've seen under the surface for the past couple of days. But how much of this is leveraged funds getting blown out or some sort of massive technical shift that's happening in algorithmic trading strategies?
So essentially, there's always going to be some kind of concerns into that level of technicals and how much that is playing out in the background. But to my mind, actually, a lot of this is driven by fundamentals. I mean, there has been, just on the tech story, there has been indiscriminate selling. So there's going to be areas of the market which are opportunities. But I think a lot of this is a fundamentally driven narrative shift, which is causing this shift to come through.
How much do you see this as continuing to support the overall index? John was pointing out that the equal weight of the S&P 500 had just reached a record high. You're actually seeing more gainers than losers. More than 350 of the 500 members of the S&P 500 gained yesterday, which is one of the biggest going back. I mean, how much is this sustainable if you don't have the leadership of some of the tech giants?
Right. The arithmetic isn't great, right? We need almost those big tech companies to be performing well and delivering in order to get those big gains. Is why the 7,000 level just seems to be so difficult to pass for the S&P 500. We should, as you said, we've seen a lot of other companies doing fairly well. But certainly, as we're looking out as a full year for the S&P 500, we're not expecting very significant double-digit gains. Certainly less than what we've seen in recent years, because without that tech drive, the maths is just more challenging.
Seema, you talk about how the true balance remains in having that exposure internationally. Where do you like?
Well, I think there's opportunities everywhere. And I think, as I said before, the global macro picture has improved. We still think that the US is one of the strongest. But certainly in Europe, across Asia, there are opportunities. So, for example, within Europe, the valuations are slightly more attractive than the US. It's not very significant. They are slightly more attractive. But we've seen this pick up in earnings growth. So areas that we continue to like, European banks, European industrials, some areas there. And then in Asia, what has been interesting is that up till this point, the interest in Asia has been, again, about tech, but because it's been trading at cheaper valuations. So I think there's certainly some assessment to be made there. But even from a China macro picture, we're, for example, expecting a bottoming out of the property market woes. And that should really feed through not to just the China fundamental story, but across to other parts of Asia. So, and then, of course, emerging markets, given the generally the weak dollar story. So we don't just have to focus on the US, and it's not about saying, get rid of all of your tech exposure by any means. It's about that kind of balance and diversification within the portfolio.
Well, Seema, let's stick on that word, diversification. If I'm buying South Korean equities, and the Kospi, by the way, has been on a wild ride, as you know, over the last week, am I getting real diversification or a different flavour of the tech story?
Right, and you're getting a bit of a different flavour. So there's diversification against US tech, but it's not really diversification against the tech story. Now, the Asian market, the Asia tech market does look slightly different, so there's going to be some beneficiaries on there. But certainly we want to be looking at other sectors as well. So this is a big story of not just country, it's asset class, and it's also sectors to try and get that bigger picture, but also to really benefit from the cyclical upswing. It's not just about avoiding, it's also about benefiting from areas that should actually do really well in this environment.
Seema, as you know, software in this country and worldwide has been absolutely hammered. There's a real margin profit risk that we can discuss. I actually want to talk about the financial risk associated with it and the divergence we're seeing on a morning like this morning between a company like Ares Management and what they're telling you about the business and what you're seeing in the stock. The stock year to date is down by 15%. They've been hammered recently, along with the likes of Blue Owl, TPG, KKR and Apollo. What you're hearing from company management is that we're seeing robust investor demand across all three of our channels continuing. We expect another year of fundraising could match or exceed our record levels from 25. What they're saying is right now they don't have a problem in the business. Do you see any financial risk building?
Well, I mean, at the moment, look, investors don't want to touch anything which has exposure to software. And unfortunately, that is a problem for these companies today. And that indiscriminate selling means that some of these are getting pulled down. There are risks, of course. We know that just looking at private markets, that there are risks lurking there. And suddenly these are such big players that we want to be kind of following that story really carefully to make sure this doesn't become something which is a real sustained selling pressure and then become something which is a little bit more systematic.
Seema, as an investor, does that make you more concerned about going into, say, even the investment grade corporate bond market, considering that a bigger and bigger proportion of it is going to come from some of these hyperscalers and some of these big tech companies? I mean, we talk about how there is a shift in the cycle and the business model. It is being financed by leverage.
So I think there are certainly some concerns. And just like we would do in the public market space for credit, we would be trying to differentiate between the sectors, which are the companies, what are their exposures, what are their safety levels. And I think that that's exactly the same for private markets. It always has been, certainly a little bit more so than now. I mean, one of the areas that we do like, for example, is direct lending. There's typically higher quality. You have more exposure to things like utilities. So I think there are areas, but just like in public markets, it really does require a deep analysis to know exactly what you're getting into.
Hey, Seema, it's good to hear from you. Thank you. Seema Shah there of Principal Asset Management. Big focus of the market over the last week. In fact, the last 5-6 months. The prospective and real disruption you're seeing in the software space. I mean, we could talk about the threat to margins and to market multiples on that part of the stock market. But it's also the financial risk associated with that and the exposure that many of these firms are carrying. And
Ares actually in their earnings reported and laid out exactly how much software exposure they had. They said that software represented about 9% of its total private credit assets, but they also went on to say that all of their software companies had continued to increase their earnings faster than the overall loan book. So again, it goes to this question of, do the fundamentals justify the financial response?
There's a difference between what you're hearing about the business, what they're telling you is on the loan book, and what investors are worried about right now. And that's the issue, I think, for a lot of people, that these stocks are being used as proxies just to kick around the story on any given day. And the management teams are coming out and trying to tell you that actually they're aware of the risks and this is how they're building or not.
Yeah, ultimately, how do you counter a story that is in faith and belief? It goes to the whole DeepSeek moment, as Annmarie was talking about yesterday. It goes to this question of how much people are just so worried about the disruption of any given software in an instant, in a way that things are developing outside of their expectations.
Equity futures on the S&P just about unchanged, but there's nothing boring about this market over the past few days. Let's get you an update on stories worldwide this morning with your Bloomberg Brief. Is Vonnie Quinn. Hey, Vonnie.
Good morning, John. Yeah, technology stocks tumbling for a second straight day as the AI-fueled sell-off from software stocks spilled over into the broader market. The Nasdaq 100 index experiencing its biggest two-day rout since October. Weakness in software stocks pointing to lingering fears of disruption by newly released tools from Anthropic. Alphabet shares down in pre-market trading after it reported fourth quarter earnings. The Google parent exceeded projections for quarterly revenue and outlined an ambitious capital spending plan. The tech giant is leveraging its growth to build out the data centers and infrastructure needed to lead in the AI age. And shares of Qualcomm and ARM also both lower in early trading. The semiconductor company signaled that a shortage of memory chips will crimp growth in the electronics industry. A shortage that is likely to persist, with Intel's CEO sharing suppliers have not told him things will improve for the next 2 years. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie in about 30 minutes' time. Up next on the programme, a fresh threat towards Iran.
I would say he should be very worried. Look, that country's a mess right now because of us. We went in, we wiped out their nuclear. Think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East.
A conversation up next with Ed Mills of Raymond James, live from New York City this morning. Good morning. Equity futures this morning bouncing back by not even 0.1% on the S&P 500. On the Nasdaq 100, the biggest two-day decline going back to August. We're higher this morning, so far at least, by 0.16%. Under surveillance this morning, a fresh threat towards Iran.
I would say he should be very worried, yeah, he should be. As you know, they're negotiating with us. And look, that country's a mess right now because of us. We went in, we wiped out their nuclear.
So that's the question. If we wipe them out,
we have peace in the Middle East. If I didn't take out their nuclear, think of it. If we didn't take out that nuclear, we wouldn't have peace in the Middle East because the Arab countries could have never done that. They were very, very afraid of Iran. They're not afraid of Iran anymore.
So here's the latest this morning. The president issuing a fresh threat against Iran. Crude prices easing, though, as both sides confirm talks this coming Friday. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. I think a lot of this has been confused over the past week. I want to get back to basics. What's the objective for these talks in the next 24 hours?
Yeah. Hey, John. Good morning. Well, it depends on who you ask, because it appears that both sides have been trying to shift the format of how these talks are going to take place. We know that Iran has now asked for these discussions to be in a bilateral format focused solely on its nuclear program, as President Trump went on in that interview to say that the U.S. has caught wind that Iran is trying to rebuild after those strikes that we saw last year. With that said, the U.S. wants these talks to expand beyond that. They want this to also include Iran's ballistic missile program, as well as its support for proxy militia groups in the region. And we heard from the Secretary of State, Marco Rubio, yesterday, who said that those top issues have to be on the table in order for there to be real progress. Now, with all of this said, as you heard, President Trump is maintaining that all options remain on the table, even as we see diplomacy moving forward for now. But I will point out that our own analysts at Bloomberg Economics assess that they see a U.S. strike on Iran as highly likely, and that these talks could really just be a stalling tactic. John, with that said, though, they also say that while the oil markets are watching this closely, if the U.S. does follow through with military action, that doesn't necessarily mean that we will see a disruption when it comes to oil flows, because there is just so much of a range of possibility on the table of what the aftermath could look like, including whether or not Iran retaliates in a symbolic way, for example. So, John, with this said, at this point, anything could really happen.
Tyler Kendall down in Washington. Tyler, thank you. To build on that, Ed Mills of Raymond James writing this. U.S.-Iran deal-making appears active and sincere, but the U.S.'s demands will be a high bar for Tehran to clear. Ed joins us now for more. Ed, welcome to the program. Let's talk about those U.S. demands. What are they?
Well, they don't want any reactivation of the nuclear program, as Tyler highlighted, any support for those proxy groups. President Trump wants essentially probably regime change, which is part of the high bar that we think that is unable to be cleared. Here at Raymond James, we consistently get questions about this. But one thing that we have highlighted consistently on a lot of these high geopolitical risks out there is that they have been coming fast and furious, oftentimes unprecedented, but often without a huge market impact. So from a market lens, this here kind of is important, but maybe not as important as other geopolitical events related to Iran have been over the last decade or two.
Ed, what do you think the tolerance the president has right now in terms of how long he's willing to let the talks go? Because we have seen the Iranians change the tenor of the talks and also the location of the talks.
I think he's open, but I don't think he has a huge tolerance here. I think there's two things. When we look back to kind of the attack on Iran last summer, the president outlined kind of some clear issues. He gave a deadline, the deadline passed, and he gave the order to strike. I think we could see the same thing here, Annmarie. What I've seen kind of consistently from this president, though, is that he will only strike, take a military action if he thinks that he can have a quick win. as well as the response is not going to get him entangled into something deeper. And so to me, that's one of the big debates here. Is there something that he can do here that he views is that quick win, that he can send that message to the regime, that he can get that activity or that response that does not involve the loss of U.S. lives? If he has that on the table, he absolutely takes that. If he doesn't, that's where he might pause and give a little bit more leeway to these talks.
Well, Ed, what would you characterize as a quick win? Because the Iranians say that if there is an attack, this could be a regional conflict, a bigger one.
Yeah, so I think that the two examples that I would give is the kind of the assassination of Soleimani back in 2020, where that was a clear, kind of concise military action. The attack on the military or on the nuclear bases last summer, you could probably kind of look to that in a pattern in terms of the way in which he was able to capture Maduro without the kind of loss of U.S. lives. He looks at a lot of these military engagements as, is there something specific that is significant but quick that he can do? And then we look back to what happened after Soleimani, after those nuclear strikes. Iran did respond, but they responded in a way that was not escalatory, in a way that was almost symbolic, that allowed us to move on. And I think that's actually part of the reason why the markets have not responded, is they are used to accustomed to this quick win attitude that Trump takes to some of these foreign policy engagements. As long as that stays in place, that's where the market does not necessarily react to these events just yet.
We were talking to Terry Haynes yesterday about how this is a president who can chew gum and walk at the same time and deal with international and domestic at the same time. The international is just getting more and more active, even as we focus on some of these domestic issues. We also had that call between Xi Jinping yesterday and President Trump, a number of headlines coming out of it. What did you take away from that? This trip by President Trump to China in April, then the promise that by the end of the year, Xi Jinping would be coming to the White House.
Yeah, so it's basically our base case. We had last year kind of the meeting between Trump and Xi in late October, which laid out kind of these two kind of home and away meetings. What we've heard from our contacts is that President Trump has sent a message to his administration: do not do anything that is seen by China as escalatory or punitive to them. We look at the tariffs that came out on semiconductors, the tariffs that came out on critical and rare earth minerals. Those were essentially a punt. And the semiconductor tariffs were a punt until April. What we expect as these two leaders get together is kind of some fanfare, some announcements that sound bigger than that they are. But there is generally a desire between both Trump and Xi to contain this relationship because they don't want the fight. Because if we look back to last year, as we entered the year, there was a lot of escalation, and some of this was mutually assured destruction. They don't want to go back to that. They don't want to go back to the restrictions on rare earths. China doesn't want to go back to some of the restrictions we were putting on airplane parts and chemicals, because both economies cannot work unless the other economy provides them with some critical components to their supply chains.
And does this mean that we can avoid new tariff headlines for at least the next 4 weeks?
I will never say that. The reality is that both Trump and Xi like to escalate to de-escalate. And so my base case, as we get closer to those April meetings over this next couple of weeks or months, is we will always have a new tariff headline as a way of getting negotiating position. China's actually done this probably better than anyone else. As we go back to those October meetings, Xi kind of announced a whole series of new restrictions, only to take those off during meetings. And Trump was able to say, hey, I got Xi to take all of these things off that he didn't actually want to do. He just wanted to have something that he could negotiate away. So I'm always telling clients at Raymond James, watch for that escalation, because they want the opportunity to de-escalate during the meeting and not actually give up something, but sound as if they gave up something.
Our diplomacy. Ed, thank you, sir. Ed Mills of Raymond James. So many of these readouts are dressed up in diplomatic language. I actually thought the Chinese readout of that call was really important. On the margin, that was a more assertive Xi Jinping on the issue of Taiwan. And I wonder if that's going to be a feature of the talks in April.
This is what people are most concerned about. That's why everyone's watching this. That's why people are looking at TSMC moving some capabilities over to Japan. How much is China trying to say, get out of our territory?
And they've already have a détente when it comes to trade. So for Xi Jinping, this is really important, especially what's going on with the military, a massive purge in the top brass in China.
Up next on the program, we'll catch up with Mark Mahaney of Evercore as Alphabet plans to double capex, plus Yahira has your morning movers. Chip stocks looking to cash in on massive AI spending. Headline just crossed in the Bloomberg terminal. Bitcoin breaking below 70K for the first time since November 2024. Bitcoin down by more than 40% since the highs last October. It's been a bit of a crash, and I think we can call it that, together with the moves in precious metals. Not a great morning so far if you're long silver or long Bitcoin. We'll get to that in just a moment. Equity futures on the S&P 500 just about positive, up by 0.05%. Suffering the S&P from a two-day tech rout, but elsewhere, the equal weight, record highs. The regional bank stocks in the last 24 hours, very close to all-time highs. I've talked about the run that we've seen in stocks like Bank of America, JP Morgan. The banks are having a really decent run, and it's not just the regional players anymore. Pushes back against this idea it's the whole market. I'm not sure anyone really shares that idea right now. It's very, very much concentrated in software stocks, and that bled to some of the chip names yesterday too.
This is a market of dispersion, and dramatic dispersion that we haven't seen in many years, and it's the reason why you're seeing winners and losers, violent rotation away from some of these tech stocks. What this market is screaming is not the collapse of a market or a collapse of an economy. It is screaming this is a new phase of the tech cycle, and this is a new phase of the economic cycle. A lot of these stocks that are doing well signify economic growth is accelerating, not decelerating.
LSM manufacturing was really strong earlier this week. Services was okay, but okay is good enough at the moment. And the yield curve's picking up on the story. 2s versus 10s, the steepest since 22. 2-year bond yields this morning, 355, 10s, 427.36. And I imagine that's breathing some life into the bank names too.
To me, this is one of the most interesting stories. And as you just mentioned, you've got the steepest yield curve in the United States going back to 2022. How much is this part of the rotation? And this really stems from Kevin Warsh and his nomination, this idea he would potentially lower interest rates and allow growth to take off on the long end. How much is that fueling some of this rotation that's under the surface? Some people are talking about
what
that.
They say, rates dovish and balance sheet hawkish.
Exactly.
Something like that might speak to some of the move at least. You like that?
It's beautiful.
That's the yield curve. Okay, let's get to precious metals. I don't know what hand signal to do for that. Maybe it's not good for TV. Silver down by 10% this morning. Silver, even with this move, is still up on the year by 10%.
Yeah.
It has been a wild ride for precious metals. Gold this morning down by about 1.6%.
People want these precious metals to be the haven that treasuries used to be, and so much money is funneling in that you're getting volatility that is almost unprecedented and is likely to continue just because there's so much interest in an alternative to U.S. treasuries, but there isn't the same liquidity in some of these precious metals.
All these market events building over the past few weeks has been phenomenal. Just fascinating to watch how it's cascaded through financial markets, deleveraging in things like Bitcoin, precious metals, software stocks, and the market, the overall index on the S&P 500, still within a couple of percentage points from all-time highs. Futures this morning just about unchanged on the S&Ps. We count you down to the opening bell with your morning movers. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with our big story. Alphabet shares are falling 3.3% in the pre-market as investors recoil at the price tag of the AI arms race. Up to $185 billion is what it plans to spend this year. That is double last year's level. But reading through analyst notes, many see this as strategic and even encouraging to the AI story. But no doubt it is an eye-popping number that is taking time to sink in. But it is welcome news for our next names. The spending spree is lighting up the AI chip makers. Broadcom up 4.5% in the pre-market, and it is leading the gains, and that is because it is Google's partner when it comes to TPUs, the specialized chips used to run AI models. NVIDIA also up 1.25%. AMD up 1.4%, catching a break after yesterday's brutal 17% sell-off. And we end on Broadcom and ARM. Both stocks are plunging in the pre-market after issuing a warning about memory shortages hurting the smartphone market as the chips get increasingly diverted to AI data centers. Qualcomm issuing a tepid forecast saying that supply constraints, especially in China, will lead to fewer phones being made, and that means costs will be higher and demand might weaken. ARM's also facing similar issues, so its forecast came in lighter than expected. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, Alphabet exceeding fourth quarter revenue estimates and outlining an ambitious capital spending plan. Google's parent company expecting capex to reach as much as $185 billion this year. Elsewhere, silver falling sharply. A record-breaking run comes to an end. The precious metal sinking as much as 17% on the session. The latest slide wiping out a two-day recovery with the market grappling extreme volatility. And President Donald Trump acknowledging that Kevin Warsh knows his role as Fed chair.
Does your new Fed pick understand that you want him to lower interest rates?
Oh, I think he does, but I think he wants to anyway. I mean, if he came in and said, I want to raise them,
if he said that, he wouldn't have gotten the job.
He would not have gotten the job, no.
The president adding there is, quote, not much doubt that the Fed will be lowering interest rates.
Somebody could say, well, doesn't this show that the Fed lacks the same independence? Have you been listening to President Trump all this time? Of course he would say that. He wants this Fed to cut rates and thinks that this has been an incompetent Fed for not cutting rates. The bigger story is what we were just talking about, the yield curve and what that's saying, which is that people believe that Kevin Warsh will cut interest rates. Longer term, however, this could lead to higher rates on the long end, especially if you have quantitative tightening. And that ultimately is the question in markets.
Trump is just saying the quiet thing out loud. Everyone knows that to get the job in front of this president, you have to show up as a dove. You can't show up as a hawk. I think it was also a little bit more interesting what Trump said about the Fed in general that might become a problem when Kevin Warsh goes in front of the Senate Banking Committee. He says, I mean, in theory, it's an independent body. So Kevin Warsh is going to get a lot of questions about Fed independence when he goes in front of senators.
When is he going in front of senators?
We don't know. When the DOJ investigation to Jay Powell gets wrapped up, and the president said this week he is going to let the investigation continue to the end. He's not going to get involved, which means we could be here for months.
Tom Tillis isn't the only Republican on the Senate Banking Committee who's raising issues about this. There have been others also who have raised issues and said that, look, this is not legitimate prosecution. So there is more pushback to the president building under the surface.
There isn't a date on the calendar just yet. Let's put it that way. Let's get back to our top story on Wall Street. Shares of Alphabet trading lower as the hyperscaler plans to double capex spending on AI. Mark Mahaney of Evercore has an outperform rating with a $400 price target on the stock. I'm pleased to say that Mark joins us now for more. Mark, good morning. I just want to focus on that number, $185 billion. How does a company spend $185 billion when for some countries that's the budget, that's government spending? Mark, how does a company put that money to work?
I like the way you set that up. So they're doubling their capex spend from last year. About half of that is going into servers and half of that is going into land, buildings, et cetera, property, plant, and equipment. But half of it's just going to servers. So this company has got very aggressive AI expansion plans. Now, they do have lots of ways to monetize this. They do have a cloud business that grew almost 50%, and the backlog for that cloud business grew 100%. So that's a direct monetization path, very similar to what Microsoft and AWS have, Amazon have. But it also has other ways, too, as they continue to use AI to improve their ads business. That's search, that's YouTube. It is paying off. You're seeing this acceleration in search revenue growth. I mean, they're growing search faster now than at any point in the last 4 years. And I think in part, AI has helped them do that. It's helped them create a better search experience. Anybody who uses Google will agree to that. You know, over the last year or two, the Google search experience has improved, and it's also made the platform better for marketers. So they've been able to prove ROAI, ROI, they've been able to prove that, and they're asking investors to help them double down on the bet. I think we're going to shake around here a little bit. That was an eye-popping number. You're absolutely right. But I think a lot of investors are going to give them the benefit of the doubt because they've got a pretty good track record over the last year.
But they don't have a track record being a real estate company, Mark. And that's kind of what I want to get into here. They are now an asset-heavy business, and they used to be asset-light not too long ago. So they don't have a history of running the business this way. And what I'm trying to understand from someone like you who understands the inner workings of an Alphabet, how has this company changed the way it operates to get to this position it's in at the moment?
Well, I think the big change here, I guess, over the last 10 years has been the growth of Google Cloud. And this is still a minority of their revenue. Off the top of my head, I'm trying to think. They're doing like 70 billion run rate off of a company that's doing 200, 300 billion run rate. So whatever, it's about a quarter of their revenue now comes from cloud. Now, cloud is an intense, capital-intensive business. Microsoft knows that, Amazon knows that, and Google is learning that too. So part of it is that the business has changed, and cloud is a much bigger part of both its revenue and its profits. They reached record high 30% margins for their cloud business in the most recent quarter. So that's probably one of the biggest changes. But AI, make no doubt about it, in order to really succeed at AI and at the platform, at the size of this platform, a Google, a Meta, an Amazon, a Microsoft, you need an enormous amount of compute power. to serve all the applications that they have that over 1 billion users. I think it's about a dozen applications that they have that have over 1 billion users. And anyway, that's those are table stakes now. I think they can get a good return on it, but it's an extremely expensive proposition. Gen AI has made running these businesses at scale with improvements much more expensive than traditional search, but it's a dramatically better product.
But Mark, just to build on what John's talking about, it's one thing to look at these companies as innovators of new tech products. It's another to view them as massive asset managers of sorts that actually go out and choose winners and losers in the infrastructure space, in exactly what types of compute will be necessary, not tomorrow, not the next day, but in 2 years, 10 years, when you talk about what is necessary in terms of rejiggering some of the chips that get older. How do you pick the right management teams for this when you're comparing, say, a Google versus a Microsoft?
Well, it's wonderful that you've got management teams with this much tenure. I mean, I'll give Google a lot of credit on this. The very first time I saw Sundar Pichai present at a Google I/O, their annual developer conference, this was 8 years ago. His principal topic was AI. So Google's been chasing AI, investing in AI, deploying AI throughout its platform, throughout its applications for many years now. There was a huge debate in the market a year ago as to whether they'd missed the AI train, they were going to have their lunch eaten by ChatGPT. All of that turned out to create this wonderful, what I call DHQ, dislocated high quality opportunity for Google shares and investors a year ago. By the way, I don't think that's the case now. There are other stocks that I prefer to Google here. I think at 30 times earnings, you're kind of at a peak multiple. So you're a high quality earnings compounder, but I don't think you're not a re-rater from here. So the risk reward isn't as attractive on Google as it was at any point in the last kind of 2 or 3 years. But that said, it's still a high quality company. And look, generative AI requires a major step up level in investment. You mentioned chips. One of the most interesting things about Google is they've fully integrated up and down the tech stack. Now they have their own chips, TPUs, tensor processing units, and that's given them a cost advantage. So not only do they have the best large language model, the best frontier model out in the world, arguably, they also have, they're there with the they're there at the application layer. They're there with one of the best cloud services, and then now they have the infrastructure underneath it, including the chips. I mean, that's one of the reasons the stock is re-rated so.
Mark, it seems like you don't necessarily agree with the argument going forward that there is some sort of, I think that we might have lost him, actually. I think that he might have frozen. Anyway, it's really interesting to me that we're looking at a situation where people are questioning any kind of investment, John, right now, with the $185 billion being thought of as negative, when, say, 2 years ago, that would be viewed as a vote of real confidence in the path ahead, especially given the fact that they delivered across the board. They had actually a bonanza of an earnings report.
And never mind 2 years ago, 12 months ago, there were people who were sitting around this table questioning, and we were having the conversation that this company might be dead, facing existential risk. And then the next 12 months, it added $1.46 trillion in market cap in 12 months and rallied by more than 60%. The turnaround in this story at this company in the last 12 months, I think, has been amazing and deserves its own case study. It's not only surviving through fantastic cloud revenue, but also their own product. Their own product has surpassed expectations as well in a way that is so different to the way we discussed this company 12 months ago. And this has consequences for how we discuss the story now in software stocks. And Chris Ferro, I thought, did a fantastic job of this, of Strategas yesterday. 12 months ago, Google's dead. 12 months later, it's added $1.46 trillion in market cap and some. And I think we have to bear that in mind when we talk about various software companies being left for dead as well this morning.
That's the reason why you see people say, look, this is a time to make money, right? This is a time to identify the ones that still have staying power and have accuracy levels that cannot be replicated by ChatGPT or by Claude. Look, going forward, this is a period of massive disruption. People can't imagine it going forward. There's a real question here of who the winners and losers are. It is notable that spending more is not a recipe for being rewarded in markets right now. It might be down the line, though.
But 3 years ago, to Mark's point, Gemini was having this code red moment, the way OpenAI is having that moment right now. I would argue potentially the biggest risk right now for Alphabet and the biggest headache is the regulatory environment. You even had the DOJ in some states this week coming out and saying they don't really like the remedies when it comes to Chrome, and they actually want more difficult remedies placed on Google.
Have you seen the new Anthropic commercial?
I love it.
Taking on ChatGPT.
Oh, it's hilarious.
It's so
Hey?
funny.
I mean,
they're kind of
the
crushing
advertisement?
it.
You know,
It's expensive ad,
kind
but
of
it's
feels
funny.
like what communicating with that product feels like at the moment.
Well, that's part of the problem, and that's part of the reason why Anthropic is going to try to eat their lunch and say, look, we're not going to have ads. They're going to have ads, but if you want your personal advice interrupted by ads, go for it. Question is, how do you make money? And that's going to ultimately become a problem down the line.
Futures just about unchanged this morning on the S&P 500. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John. President Donald Trump warning Iran's leaders the U.S. could take military action against Iran if it doesn't reach a nuclear deal on its nuclear program. The president saying the Iranian foreign minister should be, quote, very worried. According to a White House official, the U.S. and Iran still plan to meet in Oman on Friday. Meta reportedly telling staff members its next-gen large language model known as Avocado is, quote, its most capable pre-trained base model to date. According to the information, Meta sent an internal memo saying it had already completed pre-training, an initial phase in the development of AI models. A federal watchdog is investigating if Nike discriminated against white workers. The Equal Employment Opportunity Commission probing if the sportswear giant's DEI objectives led to decisions in hiring and layoffs that unequally impacted white employees. Nike is the biggest company to be targeted by the agency for its diversity practices. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the program, AI eating into business.
When you think about things like software, for instance, is it a vertical software or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business?
Up next, we'll catch up with Paul Goldberg of Bloomberg Intelligence, live from New York City. You're watching Bloomberg TV. The S&P 500 held back by a two-day tech rout over the previous two sessions. Equities bouncing back by just 0.1% on the S&P. Likewise on the Nasdaq 100. On the Russell, small caps higher by about 1/3%. Under surveillance this morning, AI eating into business.
There's definitely more risk in certain industries. There's no question that you have to think about some of the lower value IT services businesses. And when you think about things like software, for instance, is it a vertical software that is sort of the system of record for a business that is very hard to rip out? Or is it some low-level horizontal software where it's easy to change and therefore the AI could lead to a big erosion in your business?
Private market firms have been absolutely hammered over the last week or so. Blew out, Ares, KKR, we've all seen the moves. Massive moves lower, down by 10-20% over the past 5 or 6 months. Now we hear from the management teams. And I want to talk about that right now with Paul Goldberg of Bloomberg Intelligence. Paul, welcome to the program, sir. We understand how the stocks have moved. Can you walk us through what the management teams are saying about the underlying business?
Good morning, Jonathan. There's still a little bit early. Blackstone actually reported, you just had a clip of Jonathan Gray. They actually reported last week, so they didn't really talk much about this subject at a call. The rest of the calls are actually starting this morning. Ares reported earlier this morning. KKR literally just crossed the wires. Ares made the disclosure that software is about 6% of their assets, total assets, less than 9% of their credit assets. They're the largest credit, one of the largest credit managers. So they don't see the particular risk there. They have been investing heavily because it's a very profitable and well cash flow business. So it's good for them in terms of the alignment with the investment portfolios. But they also always invest with this sort of a mode. So what Jonathan Gray was just saying about the low-level software versus highly specialized software, this is usually what they go after. Something that has data or a network embedded into those software programs. And if they're lending, it's usually the senior and secured loans. So those are safer loans. They're more comfortable with those investments.
Paul, this all makes a lot of sense. Why are stock investors not buying it? You've seen all of these stocks absolutely hammered over the past year, over the past 6 months. KKR coming out just now reporting that they have total operating earnings that exceeded expectations, and yet you see this ongoing rout. What will it take for investors to be convinced?
I think more transparency. Private equity, private credit, they inherently private. They don't disclose enough information, so the investors can't watch the valuations and things like that day to day. So anything that comes up as a risk always batters into the stock. So if you go back 3 months, everybody was worrying about overinvestment in AI. And these managers are very heavily invested in the infrastructure, so they were getting hurt there. Meanwhile, you see the asset inflows, organic growth in double digits. You see fees and fee-related earnings growing in solid double digits. M&A and IPO market is opening up, so more realizations, more fees related to those realizations coming to the managers. So the environment is actually somewhat better.
And Paul, what you're seeing is a little bit of disclosure. We heard from Ares earlier this morning that they have about 9% of their private credit portfolio currently in software-related stocks, 6% of their overall assets. I do wonder whether any of this skepticism among broader investors will crimp the ability of some of these private credit managers to invest and continue to finance some of these ambitious projects by the hyperscalers.
I really don't think so, because they do have the infrastructure, and especially when you talk to largest managers like Ares, KKR, or Blackstone, they're the guys who can do multi-billion-dollar checks. The smaller managers cannot, and the public markets often cannot offer the structure that these managers are. So I believe that they can actually provide something unique for that market, longer-term structures, asset-backed kind of financing that you don't typically get from a public market.
Hey, Paul, good to hear from you. Paul Goldberg there of Bloomberg Intelligence on some of these moves we're seeing from some of these names. Blue Owl's down 19% year to date. KKR's down by almost as much. These are 20% moves after they were already hammered through much of last year as well. The fears around software are legit. People are worried about margins there and profits. The disruption is real, not just prospective. And the next leg is to find out who's got the exposure. What you've heard from management teams so far this morning, it's so far so good. I'm not sure that's going to put these fears to bed, though, because we talked about this earlier. This bucket of stocks has been used as a proxy to trade this story, and that's been the story of the last 6 to 12 months.
And that's the reason why it's unclear what they could actually say in some of these earnings calls. I do wonder if you're going to see a shift among investors to prioritize liquidity after having private credit and private assets in general all the vogue. What you don't know is what's punishing these stocks, the lack of transparency. So suddenly you have to wonder, do you end up with a lot more transparency and private credit starts to look that much more like public counterparts?
And your last question to Paul was fantastic in terms of if these companies are doing so poorly in the software, is it going to mean that private credit is not going to go out and go acquire or invest in these software companies because the pushback they're getting in their top line on their stock trading?
Coming up on the program, we'll catch up with Tom Kennedy of JP Morgan Asset Management, Chris Casso of Wolfe Research, and Jordan Rochester of Mizuho. The second hour of Bloomberg Surveillance, up next.
The U.S. is in some sense unique. It remains a very dynamic economy.
I think the economy, even though it's not accelerating, it's still pretty good.
The labor market is soft. If you have a job, the economy moves forward.
We think we're set up for a very strong year of growth, and that will come with it labor market strength.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Following a two-day tech stock rout, we've got futures up by 1/10% on the S&P, on the Nasdaq 100 higher by 0.08. Later on, another tech test. We'll get Amazon earnings after the closing bell. Going to sound a little bit like Jerry Maguire, but show me the money. $185 billion of capex we could see from one company alone for the year ahead.
Yeah, show me what that money buys, I think, is also the question. What exactly are they going to do with it that's actually going to lead to the results that people are hoping for, which is the same kind of growth that they've already experienced with a very different business model? That's ultimately what's getting priced into markets as people reassess what these tech companies are going to do. There are going to be winners and losers. Right now, it definitely is a sell first, ask questions later in the software area. At the same time, there's something else going in the tech names, and it really is this question of how they're going to spend effectively and get that kind of growth.
The context is incredible when you look at this spending. It's basically the total sum of the 3 years combined, or as Jonathan said, the entire debt market when it comes to the United Kingdom. But the CEO yesterday, Sundar Pichai, continuously tried to reassure investors, we need this money. These costs are necessary for us to continue. And remember, Gemini 3 years ago, people were saying code red when it comes to Google. They were under threat from OpenAI, and now they're the ones that are out front.
Yeah, just to clarify that, this is basically how much the UK borrowed in the debt market in the last 12 months. And when I ask the question, how does a company spend $185 billion? This is not how this company used to be run. The turnaround in Alphabet over the last 12 months is amazing. The rally we've seen of more than 60%, $1.5 trillion of market cap added to a single name in the last 12 months.
They have performed incredibly well. They've gained more than 70% if you look at the total return over the past 12 months. They've done a really good job at diversifying away from just cloud computing, although really expanding that, but also getting into the chip sales business and providing that to Anthropic. A bigger question here, though, you ask, what's it going to be spent on? They specified, this is all that they specified, new infrastructure, research, and talent. So is everybody going to get $1 billion payout? Is that research going to be sending a spaceship up to the moon to try to figure out how to create data centers? I mean, exactly what is the next step? And I think people want to understand that. That said, the ripples that you're seeing in Google this morning are nothing compared to what you're seeing in some of the other shares that are getting absolutely hammered, and it is coming off a pretty high base.
We'll all take a $1 billion payout, won't we? You know, I'd take that check tomorrow.
You know, I welcome the invitation to accept
negotiation.
that. Yeah.
Absolutely. The Bank of England with a decision out just moments ago. I wonder if this is in our future over at the Federal Reserve. A decision to hold interest rates at 3.75%, a 5-4 vote. And based on the communication we're seeing from the Bank of England on Threadneedle Street this morning, it looks like they're going to have a rate cut at some point in the near term. But ultimately, is that a little flavour of what we could see from the Federal Reserve later this year, that kind of dissent at that kind of level?
Well, maybe Kevin Warsh will get everybody together and have everybody get some sort of consensus. But you're right. How much are we going to see at an incredibly fractured Federal Reserve? Do we hear explanations for why? Because I bet from the Bank of England, you're going to hear some explanations from why from each of the individual members. My guess is that under a Kevin Warsh Federal Reserve, there might be a little bit more of a muted explanation.
Our colleagues in the UK are going to take you through the news conference in the next hour, so stay tuned for that. Right here in New York, we'll continue our coverage of what's happening in financial markets worldwide. Coming up this hour, we'll catch up with Tom Kennedy of JP Morgan as AI disruption ripples through markets, Chris Casso of Wolfe Research as Alphabet ramps up spending, and Jordan Rochester of Mizuho on the relationship between President Trump and his Fed chair pick. We begin this hour with stock steady with the Nasdaq 100 losing year-to-date gains in just 2 sessions. Tom Kennedy of JP Morgan Asset Management writing, this is an example of how selective you need to be as the market now moves into a new phase where AI disruption is becoming more and more evident. Tom joins us now for more. Tom, good morning. Good to see you. What a mess in software.
Yep, that's right. I mean, I loved this chart from Mark Murphy, our software analyst. He goes, it's going to be at least a few years before we can prove that AI will not disrupt software. So this madness of what we're experiencing, in his view, feels like it's going to be around for a while. I just love that gem from Mark. Outstanding.
That's a massive problem. So if we have to question the multiple on some of these names because we don't think the recurring revenue is as predictable and the margins might be under threat, is that a story that stays isolated to that group of names, or is it something that bleeds out to the rest of the market?
You're talking about how much capitalization is being added to certain of these tech names over time. This disruption from this technology is happening way faster than anything we've ever seen. Like, we say that a lot, but this is the discussion you guys were just having is emblematic of how fast this is.
One input from Anthropic. Bank.
And if you start to play with these tools, you can see how powerful they can be. And now software is the idea of the moment, but business services is the next discussion. The media is the discussion after that. There are ripple effects, John. So my point to say, this is the moment, and we're squeezing that balloon here. Something else will move there.
John was talking about how some of the private credit managers who have been at the epicenter of some of these investments, or believed to be, potentially, have been really beaten up. You've seen the likes of Blue Owl and Ares and KKR, all of which are reporting this morning, see massive drawdowns so far this year. I'm just wondering, do you think that private credit is the epicenter?
The private credit is just getting discussion points now, but I think rightfully so. When you look at the numbers, direct lending versus its public market equivalent of leveraged loans. Tech is 20+% in private credit, only about 15% in the leveraged loan market. Then you move to business services, 20% of private credit is in business services, and in lev loans, it's about half that, 10%. So there is a concentration risk here for AI disruption. That discussion point is just happening. Is the disruption big enough to move that far up in the capital structure, I think, is the question. And the market doesn't really know. You made the comment in the last hour, transparency. We're going to get tons of transparency. You're going to have to defend what you own and what your exposure risk is, even though we don't know exactly what the disruption will be. I think we all assume it's coming.
We saw Ares disclose this, that they have 9% of their total private credit assets related to software, 6% of their total assets.
Yeah.
You're not seeing a big move in the stock. Why is that not enough? Why is it not enough if some of these fund managers come out and say, look, this is what we have. We're good. We're the cleanest shirt in a dirty laundry.
Not to speak to Ares directly, but I think as an industry, we need more transparency into that industry. And at JP Morgan, we're talking so much about public and private and how they're going to integrate each other. Transparency is the thing that's going to integrate. So I think what the market is forcing private credit managers to want to do is to show what you own and push it out there. It's going to take more time and more than just a quote about what the percentage is.
Do you stay away from private credit and private assets for the most part, or do you move away from them in this environment?
I don't see how, let's be honest, there's no way you can move away from private markets. This is the market that is growing. This is where supply is coming. So as wealth accumulates naturally, this is going to be a part of a portfolio. However, when you look at private credit, you have to look at what you're getting in the risk reward. Right now, the spread between leveraged loans and private credit is the tightest yield we've seen in the post-COVID era. So you're not getting that much compensation to go from public to private. And at the same time, leverage has accumulated in the private space. So the compensation you're getting for that next incremental piece of leverage has come down. So I think the real conversation is, which one do I want to own? Again, when we look at our consumer data, we think the economy is in really good shape. So you want it. You can have extended credit. It's just which one do you want and how much risk are you willing to take?
Do you think private equity now needs to stay away from software?
That's going to be really hard to do. The private equity market owns a lot of software, and we haven't had the liquidity profile for them to exit those. So I think it's might be easy to say, I want to hold off on that, but you have a lot of that already, so you're going to have to deal with it.
You run real estate investment strategy at JP Morgan. Let's spend some time on that. $185 billion of capex from Alphabet.
Yeah.
How much are these players in your world now?
This is the single most defining moment in real estate we've seen in a couple decades. Looking backwards, John, what did America do? We built warehouse and logistics spaces so stuff could get put in that box and delivered to your house.
Consumption.
As fast as possible. And now we live in New York, you can get things to your house in 2 hours. But what's being onshored and the needs of these businesses is completely different than a logistics business. So again, looking backwards, we've only added 350 million square feet of manufacturing space in the last 20 years. It's nothing. But now you want to onshore a business that needs a lot of power, specific type of space, and an expertise that is only in specific areas. So this supply of commercial real estate does not exist. We need to build it. A lot of this money that you're talking about from these hyperscalers is going to the infrastructure. And in our portfolio, we own product that is high-powered and in good location. In the last 12 months, we've seen total returns for that property north of 10%, compared to a logistic and warehouse space, about 2%. This is defining, this is a new phase for commercial real estate.
Can you talk us through who has the expertise, who has the capacity to be doing this? Because one thing we tried to achieve a little bit earlier was try to understand who are the management teams driving this? Who's signing the checks, spending this money over at Alphabet? How is this getting done?
Yeah, the infrastructure build-out is mostly built around the consumer of AI. The obvious ones are robotics, aerospace and defense, pharmaceutical. So that's where the expertise is. Where do those firms really exist? For the most part, they're in Southern California, parts of Texas. But what we're seeing is interesting is now they have to move out of those areas into other places. Why? Where is there power in this country that they can get access to? Certain places you want to build a manufacturing plant that needs high power, you call the grid operator, they say, no, thank you. We don't have power for you. So you have to move elsewhere. So you're getting concentrated pockets in Southern California, parts of Texas, Southeast, and this new one you guys are going to talk about a lot is in the Midwest. So legacy types of manufacturing.
I keep thinking about the pictures of computers in the 1950s and 1960s, and they took up an entire room.
Yeah.
And now this is the same thing, my phone. And you start wondering, at what point will the technology be moving so quickly to render a lot of this real estate and infrastructure obsolete? How do you prevent against stranded assets, given how quickly the technology is moving and has to move in order to fulfill all of the promises and lofty goals of artificial intelligence?
Yeah, I think that's a real risk. I think what we're hearing from the hyperscalers, though, is they need this infrastructure, and they will spend whatever it takes to get there. And the offshoot of that is commercial real estate and manufacturing. I think this tech risk is there. I think for the most part, the tech risk is in a data center, though. If you look at a manufacturing property and then compare it to a data center, the data center might be commercial real estate, but 2/3 of the value is in the tech and the hardware to make it operate. So it has tech obsolescence. A manufacturing property can be retrofitted into something else. But something you're hitting on is different. When you walk through these onshored critical industries that I'm talking about that need this high power, it's not a car plant. It's a bunch of people looking at screens, maybe making a little widget that's going to go to Mars. Like, it's a different type of manufacturing. So it is different. But again, the clientele that is going to work in that box is very different too. They want to live near all the amenities that we care about. So it's a very unique property, but this is a defining moment for commercial real estate.
So let's put some money to work. Where's the opportunity for you and the team at the moment? Where would you deploy capital?
JP Morgan is hyper-focused on real assets as a way to diversify. I think in the media we talk a ton about gold. Investors can only own so much gold. So you have to look for other things. Infrastructure has been a play that we're focused on. In our JP Morgan Infrastructure Fund, we do not own data centers. Doesn't mean we never will, but we're trying to diversify the tech trade. And I think, you look at all these outlooks from Wall Street, they're all telling you the same thing. Tech's going to change the world and it's all the same trade. So we're trying to diversify. And commercial real estate is the best way to diversify. It is Main Street America. It has gone through a repricing, and we've only seen 2 other material repricings like this. Both times you had a 10 to 15-year bull run, and you had 4 or 5x your money over that period. This is the new diversifier, and I think you're going to see just about everybody pivot towards that.
That's the pitch. Tom, it's good to see you. Thank you, sir. Appreciate it. Tom Kennedy of JP Morgan Asset Management. Elsewhere, equities doing okay, positive by 0.2% on the S&P 500. With an update on stories worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Donald Trump says immigration enforcement in Minneapolis needs a softer touch, saying he personally decided to pull 700 agents from Minnesota. That still leaves about 2,000 federal agents in the Twin Cities area. White House border czar Tom Homan promising a shift to more targeted enforcement. The Trump administration hosting a critical minerals summit yesterday. The EU, Japan and Mexico each agreeing with the United States to set up new policies, including price floors, to help solve critical mineral supply chain vulnerabilities. The US is seeking to create stable investment conditions and reduce reliance on Chinese supplies of critical minerals. Bitcoin slumping below $70,000, falling more than 42% from its peak last October. According to data compiled by Bloomberg, investors pulled out over $272 million worth of US-listed Bitcoin exchange-traded fund flows this week. The crypto market has lost over $1 trillion in value since its October peak. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later this hour. Up next, big techs, big spending.
There's a digestion period around this spend and the implications in terms of free cash flow. I think this is very positive for the AI ecosystem overall, that this cycle is very much still intact.
Chris Casso of Wolfe Research joins us next, live from New York City this morning. Good morning. Stocks are positive across the board on the S&P, up by 0.1 Likewise on the Nasdaq, up by 0.2 on the Russell. Tech very much in focus. Under surveillance this morning. Big tech's big spending.
There's a digestion period around this spend and the implications in terms of free cash flow. I think this is very positive for the AI ecosystem overall, that this cycle is very much still intact. You have to think about this as a cycle that's almost 5 to 10 years in building relating to the capex spend, and the revenue streams are just starting to flow through.
Planned capex at Alphabet as much as $185 billion this year. So for 26, that's more than the previous 3 years combined. Who's it helping this morning? Chip makers, Nvidia, AMD and Broadcom looking to cash in. Nvidia this morning up by more than 1%. Joining us now to discuss is Chris Casso. He covers semiconductors for Wolfe Research. Chris, welcome to the program. Let's talk about where we were yesterday before we get to where we are this morning. Yesterday, it felt like at one point that maybe the pain in software was beginning to bleed into hardware, into things like chips and semis. Chris, how insulated are they from developments elsewhere?
Well, that the pain in software bleeding into chips doesn't make a ton of sense to us, because the stocks that we cover, the semiconductor stocks, are enabling the disruption that's happening, or is potentially happens. So we've been pretty positive on this, and particularly in the part of the space which has underperformed over the last 6 months, which is the chip makers themselves, the Nvidia, AMD, Broadcom. What we've seen is the suppliers to the chip makers, like memory and semi-cap equipment, has actually done very well, but Nvidia has underperformed, and that's kind of where we've pivoted a bit now.
Chris, when Alphabet comes out and says we're going to spend as much as $185 billion this year, who gets that money? Who wins it?
Well, Broadcom would be the biggest supplier to Google. They do the chip that is Google's TPU chip, which is their custom chip for AI. So Broadcom is the biggest beneficiary of that. But we've also saw big spending from Meta as well last week. This is not just a Google trend. This is an overall trend.
How much does this really indicate that they're going to be willing? I'm talking about Meta and Google and others who are the buyers of the Nvidia products, of the AMD products. How much are they willing to continue paying up? Is this a margin story that could potentially be crimping some of the dynamism in terms of the share performance?
Well, first, with regard to the spending, there's been concern about, can the spending continue? Can it grow from these levels since, really 2023 when ChatGPT came out, and now Google is spending more than the entire industry did back in at that time. So that's one part of it. Where I think investors have actually been a little more comfortable, and Google's had a good run. Meta was up on that earnings report despite the big capex. Is that the customers of the companies I cover are actually starting to monetize this now. So you're getting some monetization in exchange for this very high spending. So I think the fact that the customers of the companies I cover are actually making money on this gives us more confidence that the spending will in fact continue.
How much is Google stealing NVIDIA's lunch, especially given the fact that the TPU is considered a more efficient way to play the AI game for a lot of different customers?
Well, TPU that Google provides has been successful for some time, and they still buy a lot of NVIDIA chips, and most of those chips go into their own cloud, where enterprise customers will come to the Google Cloud and they want to use NVIDIA. And because NVIDIA is the industry standard, Google has to do that. Where Google uses TPU more significantly is in their own internal workloads. And in that, the way we look at the market is that market is considered kind of out of NVIDIA's available market. What's changed over the last couple of months is that Google has also started inviting some customers, like Anthropic, for example, to come onto their cloud and use TPU, which has expanded the market some. But in general, our view is that the vast majority of this market is still NVIDIA's domain, because it's the most flexible. They have the software support. It's very hard for other customers to kind of get off of NVIDIA. Google is a bit of an exception, and it's a big exception. But for the most part, this is still going to be a majority market for NVIDIA.
Is that going to change, though, in the future at some point, where NVIDIA's biggest competition is actually going to be Google?
Well, and the question is, so who else is Google going to be able to sell TPU to? So Google is a significant part of the market, but will they start selling it to others? And our view is that perhaps some, and the Anthropic deal is one example of that. But Google is not likely to sell TPU to Amazon. They're not likely to sell it to Microsoft. If you're an enterprise customer doing work on even the Google Cloud, you still need NVIDIA because NVIDIA has the software support. They support all the frameworks. So I think there is a competitive threat. I think it's baked into the cake right now, and I don't think that competitive threat gets much more significant. Now, one of the other factors is that everybody else is also trying to do their own chips. Meta has their own chip. Amazon has their own chip. And right now, the size of those chips is much smaller than where NVIDIA and Google is right now. If those chips kind of have their TPU moment and get larger, then that becomes a bigger threat. But so far, we haven't seen that.
Oh, sorry about that. So basically, if Google is ahead of Meta and all these others that are making TPUs, who do you think is the most competition when it comes to Google? Who's right behind them in the race?
So probably the other company that's doing their own that is probably closest would be Amazon and their Trainium chip. And so far, it's been somewhat successful, but nowhere near as successful as Google. So I'd say that would probably be the next one that we'd be watching.
Hey, Chris, it's good to hear from you. Thanks for joining us. Chris Casso there of Wolf Research on some of the chip players. It makes a lot of sense. Chris is right. Ultimately, if these companies are coming out spending loads of money, they're going to spend it with many of these players. He's also right to point out that if disruption is that real and successful right now, then what are they going to be spending money on? Chips and these chip providers.
So that's the reason why they should do well, except that there has been this rotation away and people are worried about some of the performance. AMD, they came out. They actually had good earnings.
Hammered.
They got absolutely hammered. The worst one-day sell-off going back to 2017. Why? Because it wasn't quite as good as people were expecting. So the bar has just gotten so high, even for these names, that even a wonderful result doesn't necessarily assuage some of the biggest skepticism.
In just a moment, we'll pivot and talk about central banking with Jordan Rochester of Mizuho. We'll talk about central banking on this side of the Atlantic. This is happening right now in the UK, boosting bets on easing for the Bank of England. Maybe as soon as March, we could see that rate cut. There was a vote a little bit earlier, a decision to keep rates unchanged on hold. The vote, though, 5-4. And the language clearly steering us towards a rate cut in our future, saying that interest rates are likely to be reduced further. And we raised the question as to whether we see that kind of division, that kind of split on the FOMC later this year under new leadership.
We're already seeing the beginnings of it, right? I mean, 3 governors dissenting is a significant kind of shift from what we have seen in the past. Is this normal? I think that this is really the key question. Is this normal at a time of economic disruption when you're potentially at a pivot point in the economy and people don't know where it's going? Is it normal to get a dissent in terms of opinion? Or is it a sense of the deep divisions and the fractured nature of this Federal Reserve in this particular era under a potential Kevin Warsh?
I think you're probably right to say maybe normal, absent a crisis, at a perceived turning point, which is maybe where we are at the moment in the global economy. We're down about 0.75% on sterling, cable at 135.55. Up next, Jordan Rochester of Mizuho from New York City. You're watching Bloomberg TV. At the surface level on the S&P, things haven't been too dramatic. Beneath the surface, vicious moves. Tech stocks, software names, absolutely beaten up and hammered over the past week or so. S&P 500 futures this morning rolling over. We're down by 0.25%, now down by another third on the Nasdaq, following the biggest two-day rout since October on the Nasdaq 100. The losses continue to build. The Russell also turning negative in the past 30 minutes or so. We're down by about 0.2%. We've talked a lot about this throughout this morning, that away from big cap tech, away from software names, what you've seen is an equal weight back at all-time highs. Regional bank stocks just short of a record at the close. Taking some life from this, better economic data, a better outlook, and a yield curve that's at its steepest levels, 2s versus 10s, that we've seen going back to 2022.
So is this a bad picture or a good picture from an economic perspective? It has been good Question is, will the economic data ratify it? We don't get an answer with respect to the main jobs report. We do get some other peripheral data. And so far, it's been relatively mixed, John.
We're getting some of that data right now. Let's cross over to Mike McKee for more. Good morning, Mike.
Good morning, John. Well, I got bad news for you, Lisa. The Challenger report is out, and it is a pretty dismal one. 108,435 job cuts announced in the month of January. That is the highest January total since 2009. As far as the numbers go, it's up 205% from December. There were 5,306 employers announcing hiring plans, and that is the lowest January total since 2009 as well. So some particularly bad news on the Challenger front. We don't usually talk about it, but sometimes lately when Challenger has come out, we've seen big market moves on the pessimism about what it might mean for the economy. Who cut the most? Well, transportation was the biggest, and that was largely due to UPS announcing 30,000 job cuts, followed by Amazon and there's 16,000. But healthcare, which is an unusual one to be in this category, was also big. The caveat, as we always mention with Challenger, is these are announcements, not actual job cuts, and some of those job cuts don't get carried out. So we'll have to see how this is reflected once we get into the jobless claims numbers and once we get into the payroll numbers, which is now next Wednesday.
Mike McKee, thank you, sir. We'll catch up with Mike again in about 60 minutes' time when we get those jobless claims numbers. A lot of that concentrated in just a couple of names.
Almost half of all the job cuts that were announced last month were tied to 3 companies. This really highlights just what we're talking about. Amazon.com, UPS, as Mike was mentioning, and Dow, which also announced a pretty significant broad-based cuts. It raises a question. Is this signal or is this noise? Is this a couple of companies that are shedding workers after building out their workforces dramatically over the past decade? Or is this a signal of more to come? Right now, again, it adds to the noise. This has all been so muddy. It's very difficult to get a real clear read at a pivot point.
Kit Jukes, SocGen, we talked about him a little bit earlier. Even if we had the payrolls report tomorrow, I wouldn't know what to do with it. That was Kit Jukes of SocGen earlier on this morning. Lots of people feel that way because that's been the story of the last 12 months. I mentioned JP Morgan pointing out that 40%, roughly 40% of US GDP growth in the first 3 quarters of last year came from tech capex. So when Alphabet comes out and says, guess what, this year we're going to spend as much as $185 billion, what do you trade on? That or the jobs numbers that Mike McKee just went through?
So far, people have been trading on that, not necessarily the jobs numbers that people are looking at. At the same time, we got yesterday ADP data. It came in below expectations. People dismissed that and looked at ISM services that came in stronger than expected. But if you look under the hood, the employment component actually missed expectations. So it's unclear what we're seeing. And right now, people are just focusing on the tech companies first and foremost because of the scope of the money that they have to spend.
There is a weight to the tape this morning. In the last 10, 15 minutes or so, we've rolled over. We're down about 0.4% on the S&P 500. You'll notice yields are pinned at the front end of the curve, down about 2 basis points to 353. We'll stay on top of that for you. Let's get you some single names with your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. Alphabet's $185 billion spending spree is lighting up the AI chip makers, though we are losing some steam here, as you just said. We are seeing Broadcom leading the gains up 2 3/4%. And that is because it is Google's partner for TPUs, which are the specialized chips used to run AI models. NVIDIA also in the green. AMD up now just 0.2%, though it did have a very brutal sell-off yesterday, down 17%. Meanwhile, we are seeing Snap shares rising in the pre-market, up 0.8%, also losing steam here after the picture social media company did beat on sales and posted a surprise profit. It posted fourth quarter earnings of 3 cents a share when analysts were expecting a loss. And part of that was because of the number of users willing to pay for a spruced up app, jumping 70%, and that spurred an upgrade by analysts over at B. Riley. And we end on Estee Lauder, close to wiping out all of this year's gains, now down nearly 14% in the pre-market after the company's new annual guidance came in below expectations at the midpoint range. But despite that, the company did beat on earnings thanks to high-end skincare like La Mer. But the bar was high, as Lisa says, and it wasn't able to clear it, so it is getting punished for it in the market.
Yahara, thank you. Thank you very much. I love Chris Harvey over at CIBC, just published. Market is selling off, sort of, but not really. Down 0.5% yesterday. It's worth highlighting that we were only down 0.5%. But when you drop 0.5% and the moves are that vicious beneath the surface, 0.5% feels a whole lot more painful than maybe it is.
Well, because it's not 0.5% if you have a tech-concentrated portfolio. It's down some 10%, even 20%. I was looking at some of the single names that, just looking at the drawdowns based on the past 52 months. Duolingo. Do you like Duolingo? I like Duolingo. It's down 78% from its high in the past 52 weeks. And it just gives you a sense of how significant these drawdowns are.
You've got to play with Duolingo a little bit more often, clearly.
I mean, I probably should get on my streak. Yeah, my kids all do it.
What language? What are you playing with?
What are you learning? Well, Spanish.
Okay, good
My
for
mom's
you.
learning Korean. She's learning Arabic.
Is she actually learning Korean, though? Or is she just sort of like gamifying the language and she can answer the questions well?
What is learning a language
can
in the modern
Can
era?
she communicate in Korean?
Yeah, but she's
Okay.
she does these things. But no, I mean, I can't. And then the accent is so
Neither can I. I'm certainly not judging. Just wondering if the product works or not.
Really? Okay. Do we even need it if we could all just have
it. I don't think
translators in our heads?
I don't know why we're talking about Duolingo. Stocks down by about 0.5% on the S&P 500. Session lows. We'll stay on top of that. On our radar this morning, Alphabet looking to double its AI capex this year to as much as $185 billion. The ambitious spending plan aiming to leverage its revenue growth to build out data centers and infrastructure. Elsewhere, the Trump administration pitching price floors for critical minerals and U.S. private equity investment. America committing to a $100 billion lending authority for critical minerals and a nearly $12 billion stockpile in an effort to reduce reliance on China. And finally, Treasury Secretary Scott Bessent set to return to testify on Capitol Hill today after a fiery House hearing just yesterday.
So I ask you, Secretary Bessent, will you be the voice of reason in the administration and urge Trump to stop waging a war on American consumers and on housing or affordability and putting the economy at risk? Yes or no? You don't have to explain.
Representative Waters,
will you be the voice? Will you be the voice? Can you shut up?
Bessent testifying that he believes the Federal Reserve has lost the trust of the American people by allowing inflation to get out of control.
This was fiery, and that wasn't even the most fiery moment. The other one was from Representative Meeks from New York, where I believe an F-bomb was dropped at one point.
What was that about?
This was an incredibly contentious hearing, and the Treasury Secretary also came back every single time. At one point, he said, "Can you maintain some level of dignity?" He hit back to some of these individuals. Under his breath, he said, "Well, the questions need to be serious for me to give you a serious answer." It potentially, when it goes to the Senate, will have a little bit more decorum, but I'm not sure.
Did we learn anything? I'm serious. Like, was there any news value whatsoever from this?
Didn't we have this conversation yesterday about this?
We could have it next week. We could have it after tomorrow's or today's hearing.
He said some things that we've been talking about on this show. He once again reiterated that the U.S. has a strong dollar policy. There was some things you can glean and learn into, but yeah, this is obviously everyone just making campaign videos.
That's not the hearing that Chair Hill would like to have, I imagine. I'm not sure why that descended into such a farce.
There's actually really interesting questions to be answered.
Yeah, obviously.
Honestly, what does a working together look like between the Treasury and the Fed? What does he see in terms of exactly how the U.S. takes stakes in companies? How does some of these reserves actually function? These are the questions that actually would have market ramifications. Instead, we're stuck with other things.
Maybe someone will ask him a little bit later. I won't hold my breath.
I was about to say.
But we'll see. Let's stick with the central bank. President Donald Trump emphasizing the litmus test for his Fed chair nominee.
Does your new Fed pick understand that you want him to lower interest rates?
Oh, I think he does, but I think he wants to anyway. I mean, if he came in and said, I want to raise them,
if he said that, he wouldn't have gotten the job.
He would not have gotten the job, no.
Jordan Rochester of Mizuho writing this: how long until Trump turns on Kevin Walsh too? Jordan joins us now for more. Jordan, welcome to the program. Are you suggesting he will, and why?
No, I'm not suggesting he will. We're just pointing out that the last time he chose a federal chair was Jerome Powell, and it took about a year from saying he was his pick to calling him clueless. So Kevin Walsh has to walk a pretty tight tightrope here. The data over the next month or so, I think, will be pretty darn strong. I think we're starting to see the fruits of Scott Bessent's efforts, which is the One Big Beautiful Bill. We're starting to see a big pickup in manufacturing. We're starting to see that data surprises scream higher in the US. So for the next few months, it'll be a difficult environment to be too dovish, is the sort of view from here. Things might change by June when Kevin Walsh takes over in his first meeting. But if Chair Powell is still there, if there isn't a majority agreeing to cut rates, then it might not be Trump turning against Walsh, but it might be Trump putting pressure on the other members of the FOMC instead.
Jordan, the market has a really interesting response to the Kevin Warsh nomination. It is that at the front end, you're going to see rate cuts, and at the long end, you're seeing yields bleed higher because they do believe that that the economic data is going to be strong and that you are going to see some persistent inflation. What do you think a Kevin Warsh Federal Reserve will do, and how will they respond to long end rates that are going higher?
Well, I think the interesting thing about Kevin is he talks about the need to get away from this swivel chair sort of narrative, the sort of backward-looking monetary policy that we've had from various central banks, where it's all about being data dependent. And the problem with being data dependent is each non-farm payrolls report, whether it's hot or cold, completely changes the narrative for market pricing. And it has felt like monetary policymakers have kind of blown with the wind on that. So just any small beat in non-farm payrolls has completely changed what we needed to price in for the year end. Kevin wants to move away from that sort of data dependence and be more forward looking, and is talking about AI being a big disinflationary force, especially in the services sector. And that means instead of using the last couple of months of data to justify a decision, you use your foresight and your forecasting skills to say, look, inflation might be high today, but we think it's going to be much lower next year or the year after. Therefore, we're going to go ahead and cut rates. But that's a big change in reaction function. It means that markets will not react in the same way to each non-farm payrolls report and CPI release like they used to. It actually suggests lower volatility, but things will still develop as we'll see.
What I'm trying to say, Jordan, is if you have a Fed chair that's saying, OK, we can cut rates because there is this greater efficiency, and you get this sort of disinflationary boom that people are hoping for, how does he respond to a long end of the yield curve that disagrees with him, that seems to be moving in the opposite direction?
Well, it's also his views on the balance sheet that will contribute to that view, where it's not really disagreeing with him. It's more about the demand supply dynamics. And Kevin also talks about a smaller balance sheet, and there's a large amount of US Treasuries in that balance sheet as well as MBS. If he's talking about shrinking the balance sheet, that means more supply for US Treasuries. So it does mean a steeper curve. But what I will say is on the street, it seems a near unanimous consensus of strategists pushing for steepeners, for the curve to steepen. That is higher yields in the long end, so your sort of 10-year, your 30-year. Everyone seems to have the same trade on, so therefore it's not moving as quickly. In fact, it's flattened slightly over the past couple of sessions. So for the time being, Kevin will take comfort in that the market's not moved too much, but we'll have to wait and see. I just don't think he will reduce the size of the balance sheet that quickly, and I think that's a consensus as well, and therefore we don't need to worry about it too much. But rising US yields on the back of rising US growth, which is what we're talking about right now, it's not the end of the world. It's actually a good thing.
Jordan, we heard from the president saying he wouldn't get the job if he didn't want to lower interest rates, and you outlined how Kevin Warsh thinks about this, but do you think he can convince the rest of the committee, more than just Steve Myron?
Now, when the boss is there, things might change, and other members of the FOMC might start to see to his way of thinking. I think a lot depends on whether Powell gives up his position or not as a board member. If he was to bow out, then I do see perhaps a move towards the Kevin Warsh view of the world. But if Powell is still there, arguing against rate cuts in June, that's where we could see one of the first sort of dissents against the governor since the time of Paul Volcker.
Jordan, final question for the two people that know what Aston Villa is. Top four finish this year?
Fingers crossed. We're third at the moment. We didn't play so well against Brentford, but we've got a couple of sort of fixtures coming up where I think we're going to have a good win. Top four is the ultimate aim. We're not going to win the league, but Champions League is on the way.
Jordan, thank you. Appreciate how sincerely you responded to that question too. Jordan Rochester there of Mizuho. Jordan, thank you very much. Let's turn back to this market. Equities session lows rolled over quite aggressively in the last 30 minutes or so. We're down 0.6% on the S&P 500. You'll see in the bond market, yields started to roll over as well. So we're down a basis point or two, particularly at the front end of the curve. Two's down to about 353. Hard to pinpoint one thing. This has been accumulating. We've seen it in software stocks and the risk aversion building there. Bitcoin with a break of 70K a little bit earlier on in the session too, and then that headline at about 7:30 Eastern time on the amount of job cuts we're going to see from certain companies to start the year.
The pillar that's been upholding this market, at least at the index level, has been the promise of stronger growth. When you get a challenge to that from these challenger job cuts, no pun intended, that really raises questions. And I think on the margins, people are looking at this and saying, OK, if you have a pretty fragile labor market with not a lot of give, what do job cuts like this really translate into when people have a hard time getting a new one on the other end?
You can understand why people are bullish about the outlook. There's three pillars for that. fiscal policy, tax refunds, monetary policies, the rate cuts we've already had. And then you've got this additional layer. The fact that you've got a handful of companies going on a monster spending spree, the likes of which we've never seen in economic history. Alphabet coming out with $185 billion, tops maybe, for the year ahead. And other companies are going to follow. That's why the bulls are so bulled up, because in their view, the reason they have this really bright, optimistic outlook for the US economy, they're three pillars that are hard to fight.
They see the 1990s all over again, and they want to get in on it, especially if it's 1996. The problem is, do you get the jobs that come with that, and can the consumer keep upholding this type of nirvana? And that, I think, is still, it really remains to be seen.
Stocks are softer. We're down by 0.6% on the S&P with an update on stories worldwide. With your Bloomberg brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. U.S. companies reporting the largest number of job cuts for any January since the Great Recession in 2009. According to data from Challenger, Gray and Christmas, January job cuts rose over 100% year over year. The report also showing hiring intentions sliding to their weakest total for any January since 2009. Shares of Shell trading lower. Europe's largest oil company missing on fourth quarter profit due to lower crude prices and weak oil trading. Shell maintaining its quarterly share buyback of $3.5 billion, even as lower crude prices weigh on plans to boost investor returns. Peloton share is lower in the pre-market as well. The company reporting weaker than expected revenue forecasts for its fiscal third quarter, disappointing investors who hoped a recent hardware revamp would help spur a long-promised turnaround. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Appreciate the update. Thank you very much. Up next, surging expenses.
In order to really succeed at AI and at the platform, at the size of this platform, a Google, a Meta, an Amazon, a Microsoft, you need an enormous amount of compute power. I think they can get a good return on it, but it's an extremely expensive proposition.
Up next, we'll speak to the Bill himself, Dan Ives of Wedbush from New York. You're watching Bloomberg TV. Live from New York City, here we go again. We're down by 0.5% on the S&P 500. The Nasdaq down by 0.9. Under surveillance this morning, surging expenses.
In order to really succeed at AI and at the platform, at the size of this platform, a Google, a Meta, an Amazon, a Microsoft, you need an enormous amount of compute power. Those are table stakes now. I think they can get a good return on it, but it's an extremely expensive proposition. Gen AI has made running these businesses at scale with improvements much more expensive.
So here's the latest this morning. Big tech ramping up spending plans as a global slump in tech rips through markets. AI fears wiping out about $1 trillion in software stocks over the past week. Dan Ives of Wedbush writing, we believe the market is baking in a doomsday scenario for software companies in the near term, which we believe is extremely overblown. Dan joins us now for more. Dan, good morning.
Great to be here.
Where's the black tie?
Look, given futures, I was thinking maybe wearing like a blue suit but again,
we're close. Look, you say a doomsday scenario for software stocks. Some people might say, actually, this is the most optimistic outlook for the AI theme, the fact that this is happening.
Look, I think, in my view, the view that software is dead, do not enter zone because of AI, I think is wrong. Because if you look, is it a headwind for Salesforce, for Adobe, for ServiceNow? Of course. But what's factoring in here is basically a structural breakdown of the sector. I mean, you'd have to assume that numbers come down 15, 20% next few years relative to the install base, maintenance, ARR. My whole point is that in moments like this, market's way overshot here. I just believe there are opportunities, and you cannot just paint all with one brush saying software is done.
So how actively are you buying right now?
Yeah, I mean, look, I've heard from clients I haven't heard from in a decade, because it's that nervous of an environment to be like, what do you own? And that's what we've talked about, like Salesforce, CrowdStrike, I think Microsoft here.
How do you compete, though, with the likes of $185 billion of capital expenditure in 1 year? How do you compete with some of the hyperscalers that are investing in every facet of the tech world if you're a smaller company that used to be big but doesn't have the same sort of multifaceted bunch of revenue streams?
Yeah, and look, there's going to be pure plays, smaller, that could get acquired. I mean, I think ultimately, if you're private equity here, you're a big strategic, they're going to be looking at software. I mean, I think this is going to catalyze a huge M&A in software, because when it comes to the use cases, the only one that's really shown it so far is Palantir. Now then it's like, okay, Snowflake, Mongo, that's sort of next in line. But to say that Salesforce is not going to be able to monetize it, ServiceNow is not going to be able to monetize it. You know, if you look at like what's happened in cybersecurity, CrowdStrike, Palo Alto across the board. So look, my whole point here is that we are going through almost like a mini DeepSeek moment from a year ago relative to tech, gut check moment, what's happening. But I believe that you're starting to see what I think are going to be huge opportunities in software.
These are crash level moves. I think we all appreciate that. You can see that on the charts. The question I'd ask you, though, as an analyst, is whether you have to reassess the appropriate multiple on some of these software names now, where you can have an input on Anthropic that can change the game so many times, so many different ways for so many different companies, that the recurring revenue we'd put a big multiple on is now less predictable, that the big fat margins are now threatened. Doesn't that multiple have to come down?
Look, I think it's TBD, because to me it's like, let's say like if I look at like what Anthropic yesterday, if I'll talk to 10, 15 customers of software buyers, so it's like, okay, like, is this going to affect the move? Is this real? It's like, for us, it's trying to separate the headlines from the reality of what could really happen. Now, look, is this a headwind? Does it cause disruption? Yeah. But does it mean Palantir should be down 10 to 13%? Does it mean that the software index, you know, so far this year is down 18%? So I think that really is opportunity. I think, look, between now and next time I see you, I think software rips from here higher relative to just how oversold it is. I mean, look, I was just, you know, in the Uber before, you know, the guy was negative on the software sector.
We'll cut that and play it back. And we'd like to see a change of clothes too, right?
If there is not any kind of ripping in the stocks, you are going to come on in a black suit, black tie, white shirt.
Done? Deal?
All right.
Dan, final question before you go.
Deal.
Front page of Barron's over the weekend. I read the piece, very critical of you about disclosures, all those kind of things. I want to give you 30 seconds to respond to that.
Yeah, I mean, look, I covered tech 25 years, you know, and obviously that's created opportunities from an analyst role into other opportunities that I've talked about. You know, it's all out there. Again, for me, it's more the AI revolution. I live and breathe it. Inside and outside work, philanthropy, and others. And I get the criticism, but I'm an open book. Investors have known me for decades and decades. That's why they follow me. But look, it's the reality of this, you know, environment. But again, it's one, like, I stand on, you know, everything I've done over the decades, but thanks for bringing it up.
I remember when you used to wear a normal suit. I remember those days too.
Exactly.
It's good to see you, Dan.
We might be going back to that.
I know.
Dan Eisen-Wedbush. Thank you, sir. Thank you very much. Coming up next, Liz Ann Saunders of Charles Schwab and a whole lot more. The third hour of Bloomberg Surveillance, just around the corner.
This is an environment of winners and losers.
The sum total in our mind is that people are cautious with regard to technology.
There is anticipation of disruption.
AI is creating a major disruption.
The real asset bubble is still in front of us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your price action looks like this. It looks like yesterday. We're down 0.5% on the S&P 500. Following the biggest two-day rout on the NASDAQ since October, we're down again by 0.8%. The next big test for big tech after the closing bell. Numbers from Amazon. After numbers from Alphabet were pretty good. Topping estimates and coming out with up to $185 billion of capex for the year ahead.
They also came out with a 48% increase in terms of their use and sales of cloud computing. This is a huge boon for that whole unit. What can Amazon say? Hold my beer. We're going to invest $250 billion. I mean, and how does the market respond to it? Right now, any massive capex plan is being penalized in the market, regardless of the success of prior performance. And that, I think, has been a theme throughout. People are wondering whether the multiples have to change in a new era for technology.
Things were fairly steady until about 30 minutes ago, at least on the session so far. Then this headline dropped. Challenger job cuts for the month of January. The most to start any year since 2009. And when you talk about 2009 and jobs, at least at the start of that year, that's not a good story to tell.
And the actual number is pretty significant considering the fact that we're not creating that many jobs every single month. It's 108,000 jobs plus. However, and there is an asterisk here, we already knew about a significant proportion of these job cuts. About half of them account for 3 companies that have already announced job cuts. That, of course, has to do with Amazon, UPS, and Dow. So is this a question of the market just trying to look for good and bad news and resetting? Or is this actually a worry that a lot of these people won't be able to find other jobs? I'm not sure I totally understand this market response this morning because, again, a lot of this was already known.
Well, I wonder if the market's also leaning heavily on this because we're not going to get the jobs report this week. We have to wait for next week. But these announcements were big when they came out. Amazon, 16,000, UPS, 30,000. This is what Challenger had to say about it. They're talking about how basically means that for going into 2026, this is what companies are signaling. Employers are less than optimistic about the outlook. And we've continuously seen that when it comes to consumer sentiment as well.
We've talked a number of times about how some of this has cascaded through financial markets over the past few days, from software stocks into private market firms. Just eyeballing numbers from TPG quickly, a number of names caught up in this rout over the last week, and for that matter, for these names over the last 6 to 9 months. And when you eyeball the numbers, Lisa, there's nothing of concern, at least for now. We've heard from them, we've heard from others in the last couple of hours, and that's the distinction I think you need to make. The communication from management teams at this firm, these firms at the moment, seems to be things are okay. The worry is they won't be further down the line.
Just taking TPG, just to put some numbers to what you're talking about, they're looking at fee-related earnings in the fourth quarter of $326 million versus an estimate of $246.8 million. Significant beat, a significant beat in terms of revenue, almost $100 million more than expected in terms of what they delivered. And yet people are not convinced. There is an existential fear that business models will be so profoundly disrupted that asset prices will go to zero. And that is currently what's being priced into a whole host of different software stocks right now.
Not seeing that in their earnings, at least not now. Equity futures near session lows, down by 0.5% on the S&P. Coming up this hour, we'll catch up with Lizanne Saunders of Charles Schwab, assessing the software sell-off. Pooja Kumar of TD Securities with a rate decision looming from the ECB. And Abigail Watt of UBS breaking down the latest jobs data. We'll begin this hour with stocks adding to losses following the Nasdaq 100's biggest two-day drop since October. Lizanne Saunders of Charles Schwab writing, carnage in software stocks likely tied to the nature of speculation in the AI space. Headlines and even a slight change in the narrative can result in fierce moves. Lizanne joins us now for more. Lizanne, we have seen some fierce moves. Welcome to the program. We've seen them in precious metals, massive deleveraging there. We looked at Bitcoin earlier on this morning, a break of 70,000, software more recently hammered, private market firms too. Is there a common thread to the deleveraging we've seen in each individual pocket of the market?
Well, I think the deleveraging piece, John, is an important part of it. When you look at how much leverage had built into things like the gold trade and the silver trade, and then the fact that you had the CME raise margin requirements, that pushed a lot of speculators out fairly quickly. There was deleveraging there. Anytime you have margin issues, raising of margin requires margin calls, that has feeders into other high momentum areas. I really think one of the threads, too, is that rotation is the new momentum trade. So there's a lot of money positioned to find not just the shiny new object, but what's the dull new object, and kind of chase that rotation. And I think we stay in that environment probably at least in the near term.
How much confidence can we take, Lizanne, to your point, from the moves we've seen, an equal weight, record high, regional bank stocks just short of all-time highs? How much weight can we put on that?
I think the broadening trade has legs because there's fundamental underpinnings to it. It's not just a rotation trade, but when you look at the direction of travel, you look at the earnings growth rate, say for the cohort that is the Magnificent Seven, and you compare it to the other 493. The growth rate for the Mag 7 is still higher than the other 493, but the direction is what matters. And the direction is heading down a bit for the 7, up a bit for the 493. You're seeing it down the cap space where you've actually got not just a positive trajectory in terms of earnings growth at higher levels for an index like the Russell 2000, but a little bit more stability in that outlook as opposed to high estimates and then they get pulled down when you're in earnings season. So I think there are fundamental underpinnings. The build out of AI adding to the benefit of the more cyclical areas, be it energy or industrials and materials, that helps to explain the broadening out trade outside of the US because many of those more cyclical areas is what dominate dominate their economies as opposed to tech having been the dominant force in our economy. So I think it's a meaningful shift that probably will continue.
Given this meaningful shift that a lot of people are pricing into a number of different assets, how do you take into consideration an announcement like what we got today from Challenger Gray and Christmas, with the greatest number of job cut announcements in a January going back to 2009?
Well, Lisa, you were right to point out a little bit earlier that there's a concentration there in terms of a small number of company. But I think this is it's a potentially important data point here if it's not a 1 month blip, because much has been discussed about the low hiring, low firing kind of backdrop. Obviously, ideally, if that's going to break, it breaks by higher hiring. But if it starts to break in the other direction, I think that changes the narrative around the employment picture. It may also change the narrative as it relates to Federal Reserve policy. So if you wanted to put something on maybe the bullish for the market side of the ledger, you could point to that. I think it's too soon to tell. But you guys also pointed out earlier that in the absence of the jobs report, which of course we'll only get a few days delayed, we put more weight. And when you look at the ADP data, too, there was meat in there. Smaller companies really under pressure. The only place where job growth is robust is in those more defensive areas like health services and education, with the biggest drawdown coming in professional and businesses services. That ties into where you're seeing weakness in Challenger.
This seems like a really muddied moment, and I really just want to lean into and pair this idea with the leverage trades that you see unwinding, and this comment that you made that I think is fantastic, which is rotation is the new momentum trade. Do you see a potential at which you start to fade some of this broadening out in the near term, not the long term, because the momentum gets ahead of itself? I mean, is that sort of the recipe for 2026, is to sort of fade the extremes as this rolling ball of cash just keeps going to different sectors?
100%. And I think there's a healthy underpinning when you have sort of excess get healed, valuation excess, speculation excess via a process of rotation. I think that's an easier to stomach kind of healing of those excesses than if the bottom fell all at once. For instance, the NASDAQ at the index level has only had a 4% drawdown, maximum drawdown so far this year. But the average member within the NASDAQ is down just under 20%. So you've had sort of this internal bear market. It just happens through a process of time. I think probably most investors would choose that kind of 20% drawdown versus the index coming down 20% all at once. So it's painful if you're caught on the wrong side of the proverbial trade, but I think that's a healthy way to go through a process of healing some of this excess, particularly on the speculation side.
Lisanne, always a clinic. Thank you. Lisanne Saunders there of Charles Schwab with some great stats and some of the notes they put out. Check this out. This is from Lisanne and the team. Only 18% of the S&P 500 constituents have outperformed the index over the past year. That's up to over 50% in the last month. There's been a big shift in this market beneath the surface.
It's amazing to see the headline number down just a bit, and more than 350 of the 500 member stocks of the S&P index actually gaining on the day. It just shows how different the nature of this market is. And as Lisanne says, if you had to choose one, you'd rather this to sort of be a blow off top than one that looks like Armageddon on the headline level.
This has legs so long as the economy holds up and the data looks good. And that's kind of what Lisanne is getting at for the year ahead. The other point I would point out as well, and I think this will resonate with you, just that layer of financial risk that you have got to appreciate, that there is a channel for this to go bad. That if we are right, the way the market's pricing software stocks, which is pretty dramatic, and some people think, many think, it's overextended. But if they're right about that, then there will be losses on a lot of loan books at many of these private market firms. And that's a layer of financial risk that is difficult to price.
It's difficult to price because people don't understand how systemic private credit firms and private asset managers really have become, especially given the fact that they still play a role in financing the build out going forward. It is not like the role has ended. It also is instrumental in providing the financing for all of these data centers for some of not just the hyperscalers that have money, the Googles, but the ones that have not, which is Oracle, right? So these are some of the questions that people have going forward.
Futures down by 0.5% on the S&P 500. With an update on news worldwide with your Bloomberg Brief is Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. So, US companies reporting the largest number of job cuts for any January since the Great Recession in 2009. According to data from Challenger Gray and Christmas, January job cuts rose more than 100% year over year. The report also showing hiring intentions sliding to their weakest total for any January since 2009. President Donald Trump warning Iran's leaders the U.S. could take military action against the country if it doesn't reach a deal on its nuclear program. The president saying the Iranian foreign minister should be, quote, very worried. According to a White House official, the U.S. and Iran still plan to meet in Oman on Friday. Shares of Qualcomm and of ARM are both lower in early trading. The semiconductor companies signaled that a shortage of memory chips would crimp growth in the electronics industry, a shortage that is likely to persist, with Intel's CEO sharing suppliers have told him things will not improve for the next 2 years. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next on the programme, the morning calls, plus the latest rate decision from the ECB. Pooja Kumra of TD Securities joins us to break it down. From New York City this morning, good morning.
In Q3, Q4 of last year, the narrative around tech and AI was really about questioning of valuations, that bubble, the capex spend. And now you're seeing it shift even further, so that there's not just questions about valuations, but it's actually the models. Can they actually deliver? This is really about dispersion and understanding not just balance sheets. It makes sense that investors start to think about where else can we go.
That was Seema Shah of Principal Asset Management joining us a little bit earlier on this morning. In the equity market at the moment, we're down by 0.5% on the S&P, and the Nasdaq down by close to 0.8. That's the price action. Let's get you some morning calls. One stock in focus, Alphabet. First up, Oppenheimer, raising its price target to 360, saying benefits from AI are still in the early stages. Barclays also upping its target to 360, the firm saying Alphabet's AI story is in its full flex mode. And finally, JP Morgan raising its price target on the tech chart to 395. The firm believing the doubling of capex comes from a position of strength. The stock is down right now by 4%. It's quite a move in the pre-market.
Yeah, especially given the capex, the capital, the market capitalization of a share like this. Look, right now the market is not rewarding capital expenditure. It is important to note, though, Alphabet is up 66% in the past 12 months.
Yep.
So this decline looks like peanuts compared to the 17% decline that you're seeing in the likes of AMD. So it's all within perspective. Nonetheless, it is notable.
And Nasdaq futures down by 0.8%. That's the big story in financial markets. Want to head over to Frankfurt, Germany. The ECB, with a rate decision just moments ago. Lizzie Burden has the number. Hey, Lizzie.
Hi, John. Yeah, the ECB has held rates as expected by traders and economists, as they're expected to, not just this year, but next year as well. Officials saying that they're in a good place when it comes to the economy. Let's see if they hold up that line at the press conference with Christine Lagarde in just under half an hour's time. But they have reiterated the language that they're not pre-committing to a particular rate path, that they're going to be data dependent when it comes to making these decisions. If you remember, the fourth quarter GDP print was better than expected. So that really gave officials cover to stand pat here, John. And you'll remember that there was all of that hype about hikes towards the end of last year, started by comments from Isabel Schnabel. The market latched onto it, but it's faded away because you've had inflation undershooting the target, euro strength actually touching 120 last week, and then, of course, the tariff threats from President Trump over Greenland. But since all of those things appear to be temporary, the inflation undershoot thought to be temporary at least, the euro rally fading somewhat, and President Trump walking back his threats, what they want is to keep full optionality. That's what officials have been saying to me, and that's what it appears they've done today.
Lizzie, can we finish on one of those things you mentioned? Just unpack the move in the euro. Briefly through 120, euro dollar this morning at 117.99. There was one central bank official on the governing council out of Austria that pushed back a little bit after we drifted past 120 in the past few weeks. Lizzie, unlike Chairman Powell in the news conference last week, will President Lagarde engage with the conversation about the FX channel?
She's certainly going to be asked about it. The Bank of France Governor François Villeroy de Gallo was asked about it, and he said that the currency moves are a factor in the monetary policy making. And if you go back to comments last July, the Vice President Luis de Guindos said that 120 is the level that makes policy making more complicated. And as you say, they went through that level. The problem is that when you have such euro strength, of course, it could dampen exports. It could make that inflation undershoot more persistent. But I'm sure the way that Christine Lagarde is going to frame this is they will mind what happens with the euro. They're not targeting it directly, but they see it as a channel that perhaps could affect the inflation path, and therefore they keep it in mind when they're setting rates.
Lizzie with the latest in Frankfurt, Germany. Lizzie, thank you. The ECB keeping rates unchanged. To discuss, Pooja Kumrat of TD Securities joins us now for more. Pooja, welcome to the programme. The topic of the FX rate. This is something that Chairman Powell battered away in the news conference last week. Is it something that Christine Lagarde will engage with?
Well, she will get a lot of questions on it, but I don't think that she will be able to engage much on this front. I think just to give some context, when we got our last forecast in December, ECB was looking for Euro USD to be around 116 for 2026 and 27, and we've already broken that range. And that really tells you about March forecast. We'll need to see more downgrade on headline inflation at least.
Well, let's talk about headline inflation. So we've got inflation basically around 2%. In the Eurozone at the moment, Pooja. When you look at the balance of risk, just how balanced are the balance of risks around that 2%?
I think downside risk, and that I think that is key for markets right now, whether you look at inflation, whether you look at the currency, the oil market, as well as financial conditions. They are basically making the inflation target much more risky. But what we are also seeing, on the other hand, when it comes to Europe, is the domestic resilience factor. And that was actually is visible in the PMIs as well as growth indicators, which have been much stronger than what we as economists have expected for 2025 onwards. So I think that is one of the key things that ECB likes to linger on, the core strength that is still there. And, the German fiscal bazooka is something that we will start seeing more in 2026 as well as 2027.
I'm guessing, Pooja, this is going to be a pretty uncomfortable news conference for Christine Lagarde, because a lot of the questions have to do with things that usually central banks don't like to address. In the statement that the ECB put out, they said that the outlook uncertainty is mainly due to trade and geopolitics. What is the ECB's reaction function to, say, a currency that goes up to 122, 123? I mean, there are all these questions that ultimately they should be answering. So what do you expect them to say in terms of what the ECB's reaction function is?
Unfortunately, we might just get a boring answer saying that they don't focus on FX. But I think we also need to see the FX level with respect to how conditions in Europe are right now versus 2010 and 11, where the FX was very key because we were in the deflationary era. I think if you look at even the ECB's review, they have very vocally told us that they're less reactive to downside risk to inflation, but more towards upward side. So as long as the domestic resilience story is strong selling point for ECB, they will try to avoid talking about FX. But the moment that gets dwindling, or you see financial conditions tightening because of maybe this AI sell-off, I think that's where it's hard for ECB to ignore all the market indicators. And you can see markets are via through options trying to play a possible cut by ECB, even though they do not think it's likely.
In the United States, there's a feeling, and Kevin Warsh really articulated this, that you do get growth and it has been strengthening, but it's going to be disinflationary because of the technology and because of how our artificial intelligence is increasing efficiency. Is there a similar type of discussion at the ECB to uphold the economic growth long enough to allow people to get jobs at a time when otherwise they might be losing them, given the efficiencies that artificial intelligence are creating?
So AI is definitely a risk for all countries, but one thing that we are seeing in Europe, which is basically unique as compared to US as well as in UK, our labour market is still holding up well, and so is the service sector when you look at the PMI. So maybe the AI bubble has not reached Europe that big as compared to what it is in US and UK. So they are a bit more sheltered, but it's all markets are connected after all, and I think if it affects US, it will affect Europe. So to say if US has to go big on cuts, I don't think that ECB will not be able to cut in that circumstances.
Pooja, going back to Lisa's point, though, with the statement saying the outlook is uncertain due to trade and geopolitics, code word probably for Trump. But what about China? How does the ECB address what is going on in terms of China basically being a disinflationary force onto the continent?
Definitely a risk, something that they are looking at, and especially given the fact that we are seeing a lot of China direct, indirect exports being being sent to Europe. So that is one of the key things that they are looking at. And, you can see that Europe structurally is trying to actually get out of just pure export-based economy to more investment as well as infrastructure-based economy. So in short, they know they cannot beat China no matter what they do. The German export industry is not as competitive, and so they are looking more to dwell inside via the infrastructure and investments.
Pooja, appreciate you weighing in. Thank you. Pooja Kamra there of TD Securities, highlighting the downside risk to the inflation outlook over at the Eurozone, which is interesting at a time when Germany's ramping up government spending because of A, what you pointed out, the overcapacity out of China that the Europeans now have to eat because the US has put the walls up, and B, the fact that we've seen the euro rally back up to 120. Now, we've backed away, as Lizzie indicated, but I do wonder, and I imagine if the ECB wanted to, they can, because they often do. Will she engage in that conversation in the news conference in 20 minutes' time?
Some engagement or running some sort of interference just verbally in terms of the currency. I wonder how much they're growing increasingly worried about the disinflationary impulse, because it's coming from China, it's coming from the currency, and frankly, it's coming from AI. And a lot of the investment, it's going to military and other things that don't necessarily have any kind of inflationary pressure on the economy.
Will we get a Kevin Walsh endorsement as well from Christine Lagarde? Governor Bailey's just gone there, right?
Yeah, he welcomes the nomination of Kevin Walsh as
List
a Fed
is pretty
chair.
long, isn't it?
Is this potentially a problem for President Trump?
Prime Minister Carney,
that all of the establishment
for Walsh, if he's trying to shore up the MAGA base.
He's got a lot of endorsements from establishment figures in the past week. Coming up next on the programme, the latest round of jobless claims set to cross. We'll catch up with Abigail Watt of UBS to break it down. That data is just around the corner. If you're counting down to the opening bell, as we all are, 60 minutes away, we've got futures down at session lows, negative 0.6% on the S&P. On the Nasdaq, we're lower by 0.8. Challenger job cuts, not a great read. The worst start to the year since 2009. Yields lower at the front end of the curve by 3 basis points, 2s to 352. Jobless claim data just moments away. Equity futures on the S&P negative by 0.6%. On the Nasdaq 100 down by 0.8. We're down by 0.6 on the Russell also in the bond market. Rallying at the front end of the curve, yields down by about 3 or 4 basis points now, 351.82. Risk aversion really building in the last 60 minutes or so off the back of Challenger job cuts data, the worst start to the year since 2009. With additional data, here's Mike McKee. Good morning, Mike.
Well, this isn't going to make anybody happy either. A big jump in jobless claims last week to 231,000. The initial claims 4-week moving average is at 212,000, and the continuing claims number rises as well to 1,844,000. So jobless claims up last week. Now, the caveat, as I mentioned, there was a caveat with the Challenger numbers. There's always a caveat with jobless claims around this time of year because we're still trying to get settled out from the holidays. But if this is any indication of where we're going, it might be the start of a new trend that you do want to worry about, or at least keep an eye on. Let's just mention Challenger again. We lost 108,435 jobs in January, at least according to the job cut announcements. That's the most since 2009.
Mike McKee, thank you, sir. Mike McKee breaking down jobless claims numbers. Level and then change. As a level, 231 is not something you'd be typically concerned about, but the change gets your attention, particularly in the context of the conversation we've already had this morning about the Challenger job cuts.
That really is the key. It sort of builds on the news that we already had been hearing, which was the greatest number of announced job cuts for a month of January going back to 2009. Then you look at the jump up both in the initial jobless claims and the continuing claims, and it becomes significant. A real question here about why these jobs are being released or why people are being laid off. People blaming Amazon, UPS, and Dow. One thing that Neil Dutta over at Renaissance Macro pointed out is that when you look into the details of the Challenger job cuts, the reasons for the layoffs are all talking about closing, economic conditions, restructuring, and loss of contract, not necessarily artificial intelligence. So challenging some of the more sanguine reads on what we got earlier this morning.
Push it through the market, particularly through bonds. We're down by 4 to 5 basis points at the front end of the curve, through the belly of the curve. Twos are down by 4 to 5 at 350, just about holding on to that level right now at 351. Abigail Watt of UBS joins us around the table. Abigail, good morning. Good to see you. Starts to feel a little bit more real. Is it more than just a handful of companies? Is something else happening here?
Yeah, look, I think the one thing I would caveat is when we look at the initial claims data, we've been waiting to start to see this beginning of a seasonal uptick that you tend to see in January. This is a period where you do tend to see initial claims starting to move a little bit higher, and we're a little bit behind kind of where we have been in previous years. So in previous years, you would have seen this eking higher coming a little bit sooner. So I think potentially the kind of jump higher today is a little bit maybe of catch up. Just, we would have typically begun to see this move higher sooner, essentially. So I think this is something that we would typically seasonally see. I think one of the things that I would note in the kind of job cuts data is obviously they're very seasonal. You do tend to see a lot of kind of job cuts in January. When we seasonally adjust it, it still is a relatively elevated January increase, though. So I do think that's important. And I think it's important, as we mentioned just there, this idea of what is driving those job cuts. I think when we look at the distribution of the reasons, we've had a lot of questions from clients around how much are you seeing AI feeding into the weaker labour market, and is this an AI story? And, when you look at those job cut numbers, AI job cuts don't look to be leading the reasons for kind of why people are shedding labour.
We've seen some pretty bullish outlooks for the next 12 months or so. Easing fiscal policy, tax refunds, the rate cuts we've already had, the massive spending coming from big tech. Is it a jobless GDP growth figure? What is it?
So we are expecting that you see kind of the labour market continue to look relatively weak through the first half of the year. We do think that the unemployment rate will continue to eke higher at this juncture. We have it peaking in the summer, so we do have it pushing up to 4.6 by June. And then we actually think you see a little bit more of a normalisation, a little bit more of a strength in the labour market. And I think that's partly because one of the things that we've seen through 2025 is a relatively narrowly driven growth. And I think one of the questions is kind of if we do see this kind of fiscal policy support coming through, it's a little bit more kind of distributed. Does that then help broaden the base of growth a little bit? And I think with that broadening, you could potentially see a little bit more of a broadening in labour demand, because I think one of the things you have seen in the employment data is kind of relatively narrow drivers. Look at healthcare and social assistance driving much of the gains in employment through 2025. And I think, we would expect that you need to see kind of a little bit of a broadening out in terms of the base of the strength of employment data.
I'm struck by the absolute numbers, which aren't that high in terms of the jobless claims. At the same time, are some of the job losses more punitive this time around in a low hire, low fire dynamic because it is so much harder to get a new job?
Yeah, I think you are seeing, I think when people talk about the labour market, we're talking about a little bit of a lack of dynamism, right? This idea that it is taking people potentially a little bit longer to kind of transfer back into the labour force. I think that is part of the story, but I think in terms of kind of the low hire, low fire, I do think, we have seen the kind of pace of job cuts has been running a little bit above kind of where we were in 2019 already. Like, I'm not sure that this is a significant shift in terms of the dynamic there. I do think you're just seeing general weakness, I would say, in the labour market when you look across the metrics. That's kind of how I would read the labour market. I'm not sure that this jump in claims this morning or the kind of new number from Challenger is a significant shift. I think it's a continuation of a weakness that we had already been seeing in the data.
The noise is getting a lot louder, partly because we're not getting a lot of other data points. We're not getting non-farm payrolls until next week. We're going to get CPI, but later in the week than we normally would have gotten. How differently are you looking at some of the data that used to be the gold standard going forward, given how messy it is and how difficult it is to really understand this pivot point?
Yeah, look, I think there's a lot of kind of interpretation and care that needs to be taken when looking at the data just now in the US. I think one thing I would note is, the January employment reports have always been a very difficult thing to read. You have the benchmarking process taking place. You have new methodologies being brought in for various components. And in particular this year, the residual net birth death adjustment, which is a big part of kind of what actually is adding jobs in the figures, is being revised, and that methodology is going to change. So I think it's very difficult to get a good read on the labour market, I think, from a January employment report. And I think this one could be one in particular that is hard to kind of carry forward. And then I think, if we think about the inflation data, I think one of the things we've seen there is certainly that you've seen a shift higher in, the number of imputations that are having to be done, and you're also seeing a shift higher in the number of series that the BLS are not able to publish, so because they don't have sufficient data. So I do think there are sampling issues that are taking place in the inflation data as well. And then you add on top of that the government shutdown, right? So I think there's a lot of difficulty in reading, I think, the trends. But I don't think it's to say that it's not useful or it should be dismissed. I just think you have to kind of look at trends, right? You have to look over a longer period. You have to look in more detail, I think, and kind of really read the data with care. Maybe more than you used to.
Abigail, thank you for breaking it down. Thank you very much. Abigail Watt there of UBS, following the wrong kind of upside surprise on jobless claims. 231, the estimate 212, the previous number 209. With an update on stories worldwide, including that and more. With your Bloomberg Brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Yeah, recapping the data we just got. US jobless claims coming in hotter than expected last week at 231,000. That was well above expectations and marks an overall increase of 22,000 from the previous week. Continuing claims coming in at just about $1.84 million, and that was just under estimates. And recapping today's central bank decisions, the ECB leaving its benchmark policy rate unchanged at 2% for a fifth straight meeting. That was widely expected. Elsewhere, the Bank of England also held rates steady in a split 5-4 decision. The bank's forecast showed inflation returning to the 2% target in April and then falling below for much of 2027. Bitcoin has slumped below $70,000. That's falling more than 42% now from its peak last October. According to data compiled by Bloomberg, investors have pulled out more than $272 million out of US-listed Bitcoin exchange-traded funds this week. The crypto market has lost over $1 trillion in value since its October peak. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Crazy start to the year in financial markets. Equities near session lows, down by 0.5%. We'll break down some of the massive moves we've seen in software stocks with Abby Yoder of JP Morgan Private Bank up next on the program. Live from New York, you're watching Bloomberg TV. The opening bout just around the corner. Equity futures pulling back by 0.5% on the S&P 500. The Nasdaq down by 0.7%. Bouncing just a little bit, but you know the story of the last week or so. Hyperscalers continuing to report massive AI spending as software stocks get absolutely hammered. Abby Yoder of JP Morgan Private Bank saying capex growth will likely continue during this period and beyond, both to improve model accuracy and then to sustain user traffic. Abby joins us now for more. Abby, good morning.
Good morning.
Let's talk about these moves. You've got some great stats. Is this crash level stuff in some of these names?
I mean, this is remarkable. To your point, I mean, there are so many superlatives that we could go through in terms of oversoldness. And I think the biggest one that stands out to me is 2 years ago, software was the largest industry in the S&P 500 and is now the fourth largest at less than 10% of the index, which is just remarkable. And I think, it's a broad-based move and some of it is justified, right? But there is a sentiment overhang just generally speaking, and some things are just being thrown out in conjunction with and might not be justified in our view. But it's very, very tricky, and you have to be very picky in terms of your exposure when you're thinking about going in. And that doesn't mean that sentiment's going to change overnight, right? We're going to need to see some proof of revenue acceleration from some of these companies to get a validation that it is worth stepping back in.
The narrative has changed so quickly. If you think about where we were 12 months ago, we discussed this earlier, Google was dead. Yes. Google's now $1.5 trillion bigger. And now at the start of 26, software is dead. Is this narrative going to move just as quickly?
Well, that's the thing. I think there's this element of leapfrogging, right? It's not even just like semis versus software. It's like, which camp are you in terms of your exposure, in terms of which, private market or private company are you most exposed to? And I think that's going to change, right? Because these models are going to leapfrog. But it is interesting that this spend is increasing at the rate that we're seeing, right? I think there's an element of, and there's always been this element of the big guys can compete because they have the capital to do it. But this is just becoming astronomical in terms of the numbers and the change. And it's just becoming very evident that there needs to be this continued spend. And earlier in the week, when semis were under pressure, we were kind of as a team thinking, why is this happening? It's very clear to us that spend needs to increase. And from an infrastructure standpoint, that should benefit the semiconductor companies.
There is a theory that if you have this kind of spending, it's throwing good money after bad. And at a certain point, it's all going to come crashing down. And it's not going to necessarily lead to the same kind of profitability as it has in the past. You reject that. that. You think that actually this just leads to even more capital expenditure down the line. Why?
I mean, luckily, I think I trust these decision makers to a certain extent, right? They're really the ones at the hands of this and know what's happening, know how transformational this is. I think there's probably, a happy medium in terms of like the disruption it causes from a jobs perspective. But I do think that they're just going to need to continue to build upon this, the productivity, the capabilities of these models. If the fear is that it's going to be as prolific and disruptive as it is, then I feel like there just has to be more money that goes behind it, right? It's only been 3 years. It can't just happen, overnight, it feels like.
How, as an investor, do you decide which management teams at different tech companies are spending this money wisely and spending this money in a pretty, prolific and unnecessarily so way?
I think, historically what you would do is you would look at past, and precedent of how dollars have been spent. Has it been productive? And I think there's an extrapolation there. But then again, at the end of the day, I think that narrative is kind of shifted too, because some of those companies that had historically misspent, billions of dollars are showing real ROI on this, right? So there is an element of, okay, you can use past as prologue and use it to think about how you can maybe judge the dollars that are being spent. And I think that no matter what, all of these companies are going to spend some of this money unproductively. Like that's part of probably this build out. But I do think, seeing that ROI, seeing the different business models that are benefiting is changing the narrative around, okay, in the past, maybe this company has misspent, but now it seems like they're spending correctly, they're right sizing, and you're also seeing a return on investment already.
You say they're getting all these questions about software from clients.
Yeah.
What if Anthropic posts something about, editing a book? What is going to be potentially the next leg to fall? Could we see more of this happening in the market?
Well, that's the thing. I mean, it started obviously with software and, the business services oriented companies because it seemed like it was in the legal realm and, in the consulting realm, let's call it. But it spread so much wider. So, I stay very close to the healthcare space and that it spread to, contract research organizations within healthcare, right? 10% down on that day too. So it's spreading beyond that. And that's the kind of the point on sentiment, right? They're trying to dispute a negative. Right? That's very, very difficult and it takes a very long time to do that. And again, I don't know. I think you're going to have to basically wait. It feels like DeepSeek and Liberation Day are happening at the same time right now. and so I think
they had a baby.
Yeah, and in 1 month. And then and what really helped get us through those downturns last year was getting to earnings season and seeing a real, enhancement in terms of what they were doing from a profitability perspective. I think that's probably going to be the same case this year.
Which sectors are you more comfortable in? We came into the new year and I think you added industrials into the mix as well, stayed with financials. What are you more comfortable in at the moment?
I mean, I think there's an overhang in financials right now as it relates to a regulatory perspective. If you do have, this really, focus on affordability going into the midterms, we have this, floating 10% credit card cap that I think has really weighed on what was otherwise pretty good earnings, right? It was kind of, completely dismissed at that point. But you did get some news last night that the stress capital buffer for these banks is going to remain the same. I think that's a net positive as we move through the year in terms of the deregulatory agenda. And if this really is going to be, you're seeing all of these cyclical sectors do really well, with this cyclical upswing and this M&A cycle and this, industrial capex, like who's going to fund that? That's going to be the banks, right? So I do think there's a lot of tailwinds that come through in terms of the financial sector as well.
Abby, it's good to see you.
You too.
Hold on tightly. We've got more to go. This is quite a ride. Another 11 months.
DeepSeek, Liberation Day. What else do we want to put in there?
Crazy.
I mean, it's been a long year already.
Abby Yoder of JP Morgan Private Bank. Abby, thanks again. Thank you very much. Welcome to the programme, everyone. If you're just tuning in, counting you down to the opening bell, about 40 minutes away. We've got equity futures near session lows, negative 0.6%. The ECB news conference is underway in Frankfurt, Germany. Christine Lagarde has taken to the podium, so let's take a listen to what she's got to say.